Good morning, everyone, and thank you so much for joining us on this Saturday morning for a pre-retirement webinar. My name is Sherry Babowski. I am the Retirement Benefits Manager at the Fund Office. I've been with the Fund Office for 34 years, and between in-person seminars and webinars, I've probably done over 100 of these. So I hope that you find the information presented useful. There were 144 people registered today, so while we will cover many topics, and there will be a chance for questions, I just sort of want to give everyone a heads up that this is not necessarily the forum for individual personal questions about your record. For that, my team at the Retirement Benefits Office is more than happy to assist you with those individual one-on-one questions. So that said, let's get into the presentation. We have a few housekeeping things first. If you are having trouble hearing me, or if my voice is a little bit choppy over your computer or your tablet, you can watch the slides on your computer or your tablet, and you can call in on your telephone to hear the presentation. So on the screen is the call number and the access code, and that information was also on the emails that you received about the webinar itself. There are supporting materials for the webinar today, but don't worry if you do not have them in front of you. You can still certainly follow along with the presentation without them. There are handouts, and they can be accessed by clicking on the orange arrow on the right hand of your screen. And they were also emailed to you in the email talking to you about the participant portal and how you can pull your personal information off the participant portal. So during the broadcast today, you can ask questions. Again, I would ask that those questions be of a general nature and not specific to your individual, say, credit record or your individual situation. You can ask questions through the chat. If you're watching on a computer, a laptop, or a desktop, then the top picture is what your screen should look like. You can click on the question button. If you're watching on a tablet or maybe even on your phone, then the bottom picture on the right shows you where the question bar is located at the bottom of the screen. Today's webinar is being recorded, and it will be posted on the Fund Office website at carpenterbenefits.org. It'll probably take us about a week to get this current presentation up and posted to our website. However, if you need to leave early today or you missed part of the presentation, the summer webinar from July is already posted there, so you can certainly go out to our website and rewatch either the whole presentation, or you can, of course, move back and forth between the presentation to just watch a specific section. So that is available. Part of your email, the registration email, indicated that you need to register on our participant portal to pull a copy of your pension credits and your personalized estimates. So if you have not yet done that, the QR code on your screen, you can scan that with your phone, and that'll take you right to the participant portal. Or you can go to our website at carpenterbenefits.org, and in the top right-hand corner, there is a member login button to access the portal if you have not yet done that. The portal was a long time coming, and we're happy it's finally here. It launched earlier this year. Through the portal, you can pull pension estimates, pension credits. You can update your address, your email address, your telephone number. If you are eligible for the active working carpenter medical benefits, you can see your claims right on the portal and your EOBs right on the portal. So there's a lot of information out there, and we certainly hope that you will take advantage of the portal and use it to access your information. After you exit the webinar today, and there will be a follow-up email sent to you either later today or tomorrow, there's a short survey. It's just 6 questions about what you thought of the webinar, how easy you thought it was to pull your information off the portal. So if you could just take maybe a minute or two to complete that survey, I would certainly appreciate that. When your situation changes, we do want to know. So if you move or you get married or you get divorced, make sure you contact the fund office, the retirement benefits office, to give us your new information. And we also think that you should consider updating your beneficiary if your status changes. We will certainly talk about beneficiary designations a little later in the presentation. And then on the bottom right of the current slide, there's a legal disclaimer that our lawyers want me to say at every seminar and webinar. If there are any discrepancies between this presentation today and the actual plan document, the rules and regulations, of course, the actual plan documents will govern. I promise you I will do my very, very best to try and make sure I don't make any mistakes today so that that statement won't even come into play. Okay, so what are we going to talk about today? So we're going to talk about retirement benefits and retiree health benefits. We will briefly talk about earning pension credit and how you have earned your credit. We will spend the bulk of our time on the pension calculations and the pension payment options. We will talk about disability pensions, the requirements and restrictions. We will talk about pre- and post-retirement death benefits for your survivors. We'll talk about requirements to start your pension, applying for pension, stopping work, things like that. We'll talk about prohibited employment, what you can do and what you can't do once you are receiving a pension benefit from the plan. And we will also briefly talk about the supplemental retirement plan through John Hancock. So our first topic is how your plan benefits are determined. And let's briefly look at how you earned your pension credit. On the portal, we asked that you pull your personal credit printout. So hopefully you did that, and you can see in front of you a sheet similar to what I have up on the screen, a listing of all of your credits year by year. If you've worked both out of the construction plan and the Millman plan, you'll be able to see both funds credits listed for you. If you did not pull your personal printout, please still stay with us. I'm sure that you will still get some valuable information through the presentation today. Also, if for some reason you were or are unable to access the portal, please give the team at the Retirement Benefits Department a call next week. We can certainly mail or email you your personal credit and your personal estimates if you had any difficulty with the portal. So you have earned your credit by working for employers who have collective bargaining agreements with the union, with the council, and with the pension fund. Under the construction pension plan, you earn credits, and actually under the Millman plan too, you earn credits based on how many hours you earn within a calendar year and how many hours your employer contributes to the pension plan for on a calendar year basis. No contributions have been required from you, at least no monetary contributions, because we all know that you have all given your blood, sweat, tears, knees, shoulders, and all your body parts to the rough job that this is. But no monetary contributions have been made by you to the pension plan. Your employer has contributed to the pension fund on your behalf for each hour that you have worked over and above your union salary, your union wages. So you have never had deductions from your paycheck to sponsor this pension or these retiree health benefits. Under the construction pension plan, again, on a calendar year basis, January 1st through December 31st, if you earn 250 hours in the year, you pick up a quarter year of pension credit. 500 hours is a half, 750 is 3/4, and 1,000 is a full year of credit. Starting in 1989, it became possible to earn more than 1 year of pension credit within any given calendar year. So if you earn 1,500 hours, you pick up 1.25 years of pension credit, and 1,750 or more hours is 1.5 years of pension credit within a calendar year. If you are a participant in the Millman pension plan, the hours requirements as far as the 250 for a quarter, 500 for a half, 750 for 3/4, and 1,000 for a full year, those are the same as for the construction pension plan, But under the Millman plan, there is no provision for earning a 1.25 or a 1.5 year of pension credit within any given calendar year. In order to be entitled to a pension, you have to be vested in the pension plan. The current vesting requirement is 5 years. So after 5 years of service, someone becomes vested and entitled to a pension at the time of retirement. Prior to the current requirement of 5 years, which by the way began in 1999, there was a 10-year requirement in place from 1976 through 1998. And then prior to 1976, it was actually a 15-year requirement in order to be vested in the pension plan. On the prior slide, I talked about how under the construction pension plan, you can earn a year and a quarter or a year and a half of pension credit within any given calendar year. And those extra quarters and halves will be included in your pension calculation, in the pension money that you will receive. But for vesting purposes, a maximum of 1 year per calendar year was counted. Vesting credit is also used to determine if you're eligible for retiree health benefits and how much you pay for retiree health care benefits. So there's something called eligibility credit that is tied into your vesting credit. So on your personal printout from the portal, if indeed you look toward the bottom of that printout, you will see a total that I've highlighted here on the screen with the red arrow of vesting credits. So that's how many vesting credits that you have, and keep that number in mind when we get to the retiree health benefits section later in the presentation, because that number is going to be instrumental in how much you pay for and even whether or not you're eligible for retiree health benefits. Also off the portal, we gave you instructions on how to pull your own estimated monthly pension benefits. So hopefully you took the opportunity to do that, and you have either saved as a download or you have printed out your estimated monthly pension benefits. Letting you do this through the portal, you were able to select your own tentative retirement date. I would like to mention that no matter what retirement date you put in on the portal, the credits that are listed here on your individual estimate, those are the credits that are currently on the computer system. So what you've earned up to date. Usually that's going to right now be credits based on hours earned through August. The September work hours, your employer has until October 15th to report your September work hours, and our contributions department needs a week or two to get those all posted into the computer system and uploaded to your individual records. So you probably do not see any hours, any credits that you've earned so far through September. Of course, as you keep working and additional hours keep coming in, this total years of pension credit will keep changing on the portal. The age that you see on your estimate that you've pulled from the portal up here, that is based on your age as of the first day of the month in which you've pulled your estimate. So we count your age as of the first of the month. And what that means is if your birthday is, for example, on October 10th, if you pull an estimate for October 1st, you will find that we consider you the age that you will turn on your birthday as of the first day of the month. So if on October 10th you were going to turn 60 years old, the estimate that you pull for October 1st will show an age of 60. You do not have to wait to actually pass your birthday within the calendar month to start your pension. We count you the age that you'll turn during that month as of the first of the month. Get my slide to move here. So in the middle of your estimate, The line says single life annuity with 60-month guarantee. And that's what we're going to start looking at on our first slide regarding pension calculations. So your pension benefit is going to be determined by how many years of pension credit you've earned, the accrual rate in effect at the time your pension commences, whether or not at some point in time in your career you've experienced a 3-year calculation break in service, and the type of pension you are eligible for and you elect at the time you retire. Now, when we talk about accrual rates, the current benefit accrual rate on the construction pension fund as of July of this year is $125 per year of credit. On the Millman pension fund, the current benefit accrual rate is $66 per year of credit. And this accrual rate may vary depending on whether or not at some point in time in your career as a carpenter, you have undergone a 3-calendar-year period of time where you did not earn any pension credit. So if at any point in time you went 3 consecutive calendar years without earning any credit, then these current benefit accrual rates will not necessarily apply to any credit earned prior to that 3-year period. We call it a 3-year calculation break in service. And I have a slide coming up in the presentation that shows you an example of a calculation for a member who at one point in time had a 3-year calculation break in service. Any credit earned prior to that 3-year break period will not be paid at the current rates, but will be paid out, and your pension will be calculated using whatever accrual rate was in place at the time those credits were earned. So the pension plans provide several different types of benefits, and the construction and the Millman plan have a few different eligibility requirements. For a regular pension under both plans, you have to be vested, of course, and you have to have reached at least the age of 65. Under the construction plan, for an unreduced early pension, you have to be vested and at least 60 years old, but not yet 65. On an early retirement pension, under the construction plan, you have to be at least 55 years old and younger than 60. And in the Millman plan, you have to be at least 60 years old but younger than 65. Now, if you choose to retire on an early pension, there will be an age reduction factor involved in your calculation. Under the construction plan, that age reduction is 5% a year for each year that you are younger than 60. And on the Millman plan, it's 6.6% per year for each year that you are younger than 65. Now, these percentages are prorated on a monthly basis. So, for example, on the construction pension plan, if you commence your pension benefit when you are 59 years and 11 months old, like you go 1 month prior to reaching age 60, you're not going to lose a whole 5% on your calculation. You'll lose 1/12 of 5%. So that's about 0.417% for each month younger than 60 that you are. On the Millman plan, the same thing. That 6.6% is prorated on a monthly basis. So if you were to commence an early pension under the Millman plan when you are 64 and 11 months, just 1 month shy of that 65 age where there is no age reduction, you would lose approximately 0.55% for each month that you are younger than 65. The gentleman who asked the question about the ID number to listen on the phone, please look at the email that you received confirming your registration. The access codes are on that particular email. Okay, so let's move on with our pension types before we look at some estimates. A disability pension, we will talk about disability pension for both the construction and the Millman plan. later on in the webinar. There are also pensions called partial pensions and limited pensions. A partial pension would apply if you have worked here in Chicago and perhaps also worked as a carpenter somewhere else in the country, maybe out in California or up in New York or down in Florida. So it's a way of coordinating pension benefits with another pension plan somewhere else in the country. A limited pension applies if you have earned pension credit here in Chicago with both the construction plan and the Millman plan. So it's a way that we can coordinate benefits between the construction plan and the Millman plan together. So on the initial slide where I showed you what your estimate would look like if you pulled it off the portal, I pointed out that the first pension payment option we are going to talk about today is called a single life annuity with a 60-month guarantee. Now that's the option that is on the middle of your estimate. The amount listed there on that A option, the single life annuity option, is the monthly amount that the carpenter will receive for the carpenter's lifetime as long as the carpenter lives. There are no maximum number of payments. So if you, the carpenter, commence benefits under a single life annuity option, you will receive a monthly pension benefit in that amount for as long as you live. So if you live for another 50 years after your pension starts, you will receive that monthly amount. There is no maximum number of payments. I will say that again, there is no maximum number of payments. It's a lifetime benefit for the carpenter's lifetime. As far as a benefit due to a beneficiary when the carpenter passes away, that's where the 60-month guarantee comes in. A minimum of at least 60 monthly payments are guaranteed. So, for example, if the carpenter elects a single life annuity with a 60 certain guarantee, we take the monthly benefit accrual rate of $125 from the construction plan right now, and we multiply that by the 49.5 pension credits that this particular carpenter earned during his working career. As you can see on the slide, he worked 41 years from 1981 through 2021, earning 49.5 years of pension credit, and he never incurred a 3-year period of time where he did not earn any pension credit, so that all of his credit is paid at the $125 benefit accrual rate. Because he is at least 60 years old in the construction pension plan, there is no reduction for his age. It's an unreduced early retirement pension at age 60. So the 49.5 years multiplied by $125 brings a monthly amount of the $6,187 that's shown on your screen. So your personal estimate that you pulled from the portal will show your monthly amount. That is the monthly amount available for your lifetime, no maximum. But if you, the carpenter, passes away before receiving the minimum guarantee of 60 monthly payments, then the balance of the payments would be due to your designated beneficiary. So, for example, if the carpenter passes away after receiving 48 monthly payments, your designated beneficiary would receive an additional 12 monthly payments until a minimum of 60 guaranteed payments has been met by the plan. So 48 payments paid to you, the carpenter, plus 12 additional payments paid to your beneficiary is where we get our 60-month total. If you, the carpenter, have received 60 or more monthly payments upon your passing, then the monthly pension benefit would stop and there would not be any additional payments due to a beneficiary. Now, if you are indeed married at the time your pension starts, There are other options that we will look at in a few slides that offer you a way to take a little bit less money during your lifetime on a monthly basis, a little less money, in order to provide your surviving spouse with a monthly pension benefit for the spouse's lifetime after the carpenter's passing. Okay, but we first have a couple other examples on this single life annuity with 60-month guarantee to look at. So this next slide is an example of a construction fund carpenter who has not reached the age of 60 yet. So in this example, the carpenter is 58 years and 2 months old. He's worked for 32 calendar years from 1989 to 2020, and he's earned 42 years of pension credit within those 32 calendar years due to those extra quarters and halves for working either 1,500 or 1,750 hours within any given calendar year. So since this carpenter has never incurred a 3-year break in service, we take these 42 pension credits, we multiply by the current benefit accrual rate of $125. And then because the carpenter is 58 years and 2 months old, not yet 60, there is an early reduction factor applied to the calculation. So a few minutes ago, I told you that the reduction factor under the construction plan is 5% a year for each year that the carpenter is younger than 60. So if the carpenter goes out at 58 years old, he's 2 years younger than 60. 5% a year for each of those 2 years younger than 60 is a 10%. So there would be a 10% reduction if the carpenter started the pension at 58 years old. So this carpenter is a tiny bit older than 58 years. He's 58 and 2 months. So instead of a 10% reduction, a full 10% reduction, which would show a factor of 90% here, it's 90.833% that this carpenter will receive. These extra 2 months on the prorating is where that 0.833 comes from. So 42.5 times 125 for the accrual rate multiplied by 90.833% gives this carpenter retiring on an early pension a monthly benefit of $4,768. That monthly benefit is payable to the carpenter for the carpenter's lifetime, no maximum number of payments, but at least 60 monthly payments are guaranteed in case the carpenter passes away before receiving at least 60 payments. Okay. So the next slide is an example of a carpenter who is also retiring early, retiring at 58 years old. But at one point in time in the carpenter's working career, he did incur a 3-year calculation break. So this example, the retiree is 58 years old, worked from 1988 to 1996 and earned 11 3/4 years, did not earn any pension credit at all from the 3-year period of 1997 to 1999, but then returned to covered employment, returned to working for an employer with a collective bargaining agreement with the pension fund, and worked from 2002 to 2021 and earned an additional 21 3/4 years of pension credit. So when the calculation happens, we take the credits earned from 1988 to 1996, this 11 3/4, and we multiply those by the $50 accrual rate that was in place in 1996. The credit that was earned from 2002 to 2021, we take that 21 3/4 and we multiply that by the current benefit accrual rate of $125. Because the carpenter is 58 years old, he's taking a 10% reduction, 5% a year for each year younger than 60. So the 10% reduction means he's receiving 90% of the value of his pension. So we do the two calculations across, and then we add these two numbers together. So the retiree's monthly benefit amount will be $2,975.63 a month for the carpenter's lifetime, as long as the carpenter lives. And if the carpenter were to pass away prior to receiving at least 60 monthly payments, then the balance of the payments up to the total of 60 would be paid to the carpenter's designated beneficiary. Okay. So some of you who are married, I'm sure, are thinking, well, what happens to my spouse? What happens to a benefit for my spouse? Or is there an option for me to take a benefit to provide a lifetime benefit for my spouse? And the answer to that question is yes, indeed, there is. There are 3 different payment options available under the plan for a married carpenter to provide a benefit for the spouse in case the carpenter passes away first. So the carpenter receives a little bit less of a pension during his lifetime in order to ensure that the surviving spouse will also continue to receive a benefit after the carpenter passes away. So following the death of the carpenter, the surviving spouse will start to receive a monthly benefit, and that monthly benefit will be for the surviving spouse's lifetime, and it does not matter whether or not the spouse remarries. The spouse could still receive, in fact, will still receive the monthly benefit for the spouse's lifetime. And I have some slides with some examples. Okay, so let's move on and let's look at those. So in our first example, the retiree is 60 years old, earned 49 and a half years of pension credit, never incurred a 3-year calculation break, and the retiree's spouse is the same age as the retiree. So they're both 60 years old. So the 49 and a half years of pension credit are multiplied by the benefit accrual rate of $125 to arrive at the single life annuity 60 certain guarantee amount of $6,187 that we had on the prior slide. And if you look at your individual personal printouts that you made from the portal, you will see that there are some options further down on the printout: a B option, which is a 50%, a C option, which is a 75%, and a D option, which is a 100% joint and survivor benefit. So let's walk through these options. So in order to calculate the adjusted monthly pension benefit that the carpenter would receive for the carpenter's lifetime, if one of these joint and survivor options are chosen, the base monthly 60 certain amount of $6,187 is multiplied by what's called a joint and survivor factor. Okay, you can see your individual joint and survivor factors on your estimates from the portal. I will tell you that on a 50% joint and survivor benefit, the base factor is 90%. So that's what we see here on our estimate. And the base factor applies when the carpenter and the spouse are both the same age. So the carpenter and the spouse here are both 60, both the same age. It's a 90% factor. For each year younger or older than the carpenter that the spouse is, we add or subtract 0.4% to this 90% base. So you do not need to do that math. Your estimates from the portal show you what your individual joint and survivor factor is. So we take this 60 certain amount here, we multiply by 90%, and the carpenter in this case would receive a monthly amount of $5,568.75 monthly for the carpenter's lifetime. When the carpenter passes away, this $5,568 goes away, but the carpenter's surviving spouse starts to draw a monthly benefit of $2,784.38 a month for the surviving spouse's lifetime. Now, these are surviving spouse benefits, so please understand that the surviving spouse that the spouse does not draw a benefit while the carpenter is still living. The spouse does not draw a benefit while the carpenter is still living. It is a surviving spouse's benefit that starts the month after the carpenter passes away. Okay. And that surviving spouse's benefit starts the month after the carpenter passes away, no matter how old or how young the surviving spouse might be. So our next option, or your next option, is a 75% joint and survivor option. So the calculation happens the same way. We start with the base 60 certain amount of 6187, and we multiply by the 75% joint and survivor factor. So on a 75% option, the base factor, if you and your spouse are the same age, is 85.5%. And then we add or subtract 0.6% for each year older or younger that the spouse is from the carpenter. So in this situation, where they're the same age, it's the 6187 60 certain amount multiplied by 85.5%, and the carpenter's monthly pension benefit will be $5,290 a month for the carpenter's lifetime. When the carpenter passes away, the $5,290 goes away, but the surviving spouse starts to receive a monthly benefit in 75% of the amount that the carpenter was receiving. So the surviving spouse will receive $3,967.73 a month for the surviving spouse's lifetime. Then your final option, if you're married, is a 100% joint and survivor benefit. So if the carpenter and the spouse are both 60 years old, the base percentage on a 100% joint and survivor is 81%. And then we add or subtract 0.7% to that 81% for each year younger or older the spouse is than the carpenter. Again, your individual factors are on your personalized printouts from the participant portal. So with a 100% joint and survivor benefit, the carpenter draws $5,011.88 a month for the carpenter's lifetime. And if the carpenter passes away, the surviving spouse receives 100% of that amount, receives that same monthly pension benefit for the surviving spouse's lifetime. So on the estimate that you pulled from the portal, you have 4 different options if you are married. You have the single life annuity with the 60-month guarantee. You have a 50% joint and survivor, a 75% joint and survivor, and a 100% joint and survivor option. So when you fill out your pension papers, you will make a choice between those 4 options. Okay. And as you can see on your estimates and on the example slide here, the carpenter's monthly amount varies, and it goes down slightly dependent upon how much money the surviving spouse will draw for the surviving spouse's lifetime. So instead of $6,187 on a 50%, the carpenter's monthly amount decreases to $5,568. On a 75%, the carpenter's monthly amount decreases to $5,290. And on a 100%, the carpenter's monthly amount decreases a little bit further to $5,011 a month. So it's a choice that is made between these 4 options. Okay. You make that choice on the pension application. And oftentimes the question is, well, what if I'm married and if I take either the 50%, the 75%, or the 100% joint and survivor option? Well, if you take one of those 3 options, and if indeed your spouse passes away first, then you, the carpenter, your benefit automatically converts back to a single life annuity with a 60-month guarantee, effective the month after your spouse passes away. So the example I have up here on the slide, this carpenter chose the 50% joint and survivor payment option when he applied for pension. he received $55.68 a month. But then a couple of years, let's say 2 years down the road, his spouse passed away. So there's no longer a need to provide this $27.84 a month for a surviving spouse, since the surviving spouse passed away first. So the Carpenters amount increases up to the $61.87.50 60-month guarantee amount, effective the month after the spouse's death. So it begins the month after the spouse's death. Now, you do not get any retroactive money refunded back to you for, in my example that I just gave here, the 2-year period of time that your spouse was still with us before your spouse passed away. But that increase is effective the month after your spouse passes away. Now, the slide here says it automatically converts. So the plan option to convert this, or the plan's provision to convert this, is automatic. But we, of course, need to be notified that your spouse has passed away, and we will require a copy of the spouse's death certificate before we can make this adjustment. Now, if that takes a month or two, for you to get us a copy of the death certificate, then this adjustment, we do make the adjustment to your pension, and it is retroactive, but it's only retroactive to the month after your spouse passes away. It's not retroactive back to all the way when your pension benefit first started. Okay. Remember, you have the chat box for questions. You can certainly type in a question. I'm keeping an eye on that chat box. I haven't seen many questions come through, or at least many questions that I haven't answered as I've been speaking here. But you can put a question into that chat box at any point in time. There is also usually a question about what happens if I get divorced? What happens if my spouse and I get divorced? Okay, so if indeed you and your spouse get divorced, and if as part of the settlement agreement under the construction pension plan, this type of a pop-up feature could also happen after a divorce if you, the carpenter, are awarded your entire pension as part of the divorce settlement agreement. Now, in some situations in the settlement agreement proceedings, the spouse might also be assigned a portion of your pension for the spouse's lifetime under something called a qualified domestic relations order. So it is possible in a divorce situation, and the pension fund does not make this decision. It's between you and your spouse as part of divorce negotiations, whether or not the full pension will revert back to the carpenter, or perhaps the surviving spouse is going to be entitled to a portion of that carpenter's monthly benefit, while you're both still with us, while you're both still living. But we're going to hope that that situation does not happen for you. But during today's presentation, we need to talk about things like that. We need to talk about what happens if I get divorced and what happens when I pass away. So I hope that you will look at that as, information, and certainly not our wishing anything bad on you and your family. There is one other feature of the joint and survivor options that I would like to make sure you're aware of, and this applies only to the construction pension plan. So if the retiree has taken either the 50%, the 75%, or the 100% joint and survivor option, if the carpenter passes away after only receiving 20 months of payments, then the surviving spouse's benefit will begin at the surviving spouse's amount under either the 50, 75, or 100%. You can look at your personal printout estimates to see what that surviving spouse's benefit would be. But then what happens if the surviving spouse only gets a few months of payments? So in my example on the slide here, I'm saying, well, the surviving spouse's pension starts and the surviving spouse gets 12 monthly payments, and then the surviving spouse passes away. So we've only paid out 32 monthly payments in this situation. The carpenter got 20 payments before the carpenter passed, and then the surviving spouse got 12 more payments for a total of 32 payments. Well, we already talked about the fact that a minimum of 60 monthly payments are guaranteed. So in this particular type of a situation in the construction plan, your designated contingent, your secondary beneficiary, would receive the other 28 monthly payments in order to reach that total of 60 monthly benefits. Okay. And those other 28 payments would be at the surviving spouse's monthly benefit amount. So not the carpenter's benefit amount, but the amount that the surviving spouse was getting at the time the spouse passed away. That option is, that provision only exists in the construction pension plan. Under the Millman pension plan, the 50%, 75%, and 100% options are available under the Millman plan, but this type of 60 monthly payment guarantee is not built into the Millman plan. So under the Millman plan, you, the carpenter, would get as many months as you are with us under the carpenter's monthly benefit amount, and then your surviving spouse would get as many monthly benefits as your surviving spouse is with us. If both the carpenter and the spouse in the Millman plan pass away before 60 payments, a total is not paid up to the 60-month minimum that exists in the construction plan. Okay, so it's still a lifetime benefit, but it's not the 60 certain built into the 50, 75, and 100% on the Millman pension plan. So I see a couple of questions coming through the chat here. The first question is the monthly pension taxable? And yes, the monthly pension is indeed taxable by the federal government. Whether or not it's taxable by the state depends upon the state in which you reside. Currently, Illinois does not tax pension benefits, but if you're going to be relocating to a different state, you certainly need to check with a tax advisor or the state where you're thinking of possibly moving in your retirement to see if that particular state taxes pension benefits. The rules vary from state to state. And of course, as I'm telling you, it's not taxable in Illinois. Please know that that is under current law. There's no way for me to predict what the Illinois legislature or the Illinois government might do in the future. The next question coming through is, can the benefit payment option be changed if the carpenter chooses to do so, or maybe if the carpenter gets married after retirement? So that's sort of a twofold question. In order to take any of the joint and survivor options, either the 50, the 75, or the 100%, you, the carpenter, have to be married at the time your pension starts. Okay. If your pension starts and then you later get married, you cannot add a 50, 75, or 100% option for your new spouse. You could certainly name a new spouse as your beneficiary for the 60-month guarantee, but the lifetime joint and survivor 50, 75, 100, you have to be married at the time your pension starts. Also, for those of you who are married, the election that is made at the time your pension starts cannot be changed later on. So once you cash your first pension check, you're considered to be in retirement, and that election that you make cannot be voluntarily, I guess, for lack of a better word. So you can't go down the road 2 years with a 75% joint and survivor option and then come back to us 2 years after your pension starts and say, hey, I changed my mind, I want to switch to the 100%, or I want to switch to the single life annuity. Okay, the only way those joint and survivor benefit options are changed is if if the spouse passes away first, or if there is a divorce. Likewise, if you, the carpenter, who are married, you take a 60-month guarantee, a single life annuity 60-month guarantee at the time your pension starts, you cannot come back a year or two later and add on a joint and survivor option. Okay. Does the survivor pension have to be a spouse? The 50, 75, and 100% options have to be a spouse. So the joint and survivor benefit has to be between a carpenter and a spouse. So you can't do, say, a joint and survivor benefit with a significant other or with a child. Okay, a significant other or a child could certainly be named as your beneficiary on the single life annuity 60-month guarantee, but you cannot do a joint and survivor 50, 75, or 100 unless you're actually married. And another question, the last question that's up right now, is asking about what is the average lifespan of a carpenter after he retires? And somebody always asks that every webinar or every in-person seminar. And I do have those numbers for you. In fact, I have a couple of numbers you didn't ask for. So the first question is the average lifespan of a carpenter after retirement. And that is 19 years. The average carpenter is on pension 19 years before the carpenter passes away. The average age of our current population of retirees is 70 years old. And right now, the average monthly pension benefit that's being paid out is $1,700 a month. The longest person currently receiving a pension benefit, he has been on pension for 42 years, and his monthly pension benefit is $460 a month. So those are some stats that you maybe might find a little interesting or maybe not. Sometimes people are surprised to hear that the average monthly pension benefit is $1,700 a month, especially many of you registered here today. You have 30, 40 years of service, and your monthly calculations are significantly more than that $1,700. We have people still on pension who have been on pension for a long time when the benefit accrual rate was much, much less. I mean, for many years, the benefit accrual rate was $20, and it increased incrementally from 20 to 22. It stayed at $40 for a while. It stayed at $88 for quite some time from 2008 until the benefits started to increase up to $100 and $125. So a lot of people currently receiving a monthly pension benefit started their benefits when the accrual rates were a lot less. Okay. Another question as I'm talking just came through, and it asked about the difference between the Millman benefits and the construction benefits. And basically it's asking how come the Millman benefits are so much less. Well, the Millman contribution rate is much less than the the construction pension fund contribution rate. I actually don't have these numbers written down in front of me, but I'm going to give them to you. I think I'm pretty close. The construction pension plan, the employer contribution rate to the construction plan is about $15.75 per hour worked, and of course that's the current rate. And on the Millman pension plan, the employer contribution rate is about $8.25 per hour worked. So the Millman collective bargaining agreements have the Millman employers paying into the Millman pension fund at a lesser rate. So, less money paid in equates to lesser pension benefits, lesser accrual rates, higher early retirement age, things like that. So those are all the questions I see coming through right now. Please, as you think of them, put your questions into the chat, and I will answer them as they come across or as they fit into the presentation. If I don't answer your question right away, it's possible that answer is coming up later in the presentation. So I'm going to move on. The next estimate that would have generated off the portal when you put in your information is called a partial lump sum estimate. So if you printed your estimates, if you had a printer at home and you printed your estimates, I would suggest you put the two estimates side by side on your tabletop, the regular estimate that we just went over, and this partial lump sum estimate next to it so that you can see them both at the same time. Okay. So under both the construction and the Millman pension plan, There is a partial lump sum option. You can opt for a maximum of 10% of your monthly pension benefit as a lump sum up front. You still get a monthly pension check. It's just the amount of the pension check that you'll receive on a monthly basis will be a little bit less because you'll get part of your pension up front. There is a minimum requirement of at least $1,000 on a partial lump sum option. Your personal estimates that you printed or downloaded from the portal show the actuarial factor that is used to calculate the lump sum option or the partial lump sum option. The factors that are used to calculate the partial lump sum option change every July. So the entire table that we have, that we get from our actuaries and accountants, changes every single July and at other times as mandated by federal law. I've been here for 34 years. The partial lump has been available since 1995. Factors have changed every July since 1995. There are only 2 times that I can remember since 1995. Once the factors changed in March and once the factors changed in, I believe, October, for different reasons mandated by the government. Okay, so the entire table changes every July, but your individual personal factor on your estimates, it changes from month to month to month. So every month older you get, the factor will change slightly. So if you ran estimates for today's presentation, say for January of 2023, if you go back to the portal and you run an estimate for February of 2023 when you're 1 month older, you will see that that lump factor changes slightly. Or if you do it the other way around, if you ran your original estimate for January and you back it up and you run another estimate for December, you'll see that that lump factor changes a little bit again because you're 1 month younger. So within the tables, for every month older or younger you get, every additional month of age you attain, the factor changes slightly. But the table itself changes every July. So somebody usually asks, well, what's going to happen to the factors next July? Are the factors going to go up or are the factors going to go down? And my answer is, we can't predict that with certainty, but I can tell you that historically, there's an opposite relationship between interest rates and the factors. There's an opposite relationship between interest rates and the factors. So when interest rates are going up, the factors are going down. When interest rates are going down, the factors are going up. So I believe everyone knows that interest rates recently have certainly been going up. You know, the Fed's trying to curb inflation or, you know, whatever else their fiscal policy has involved. Interest rates are going up. So this year, this July, when we got the new tables, and we don't get the new tables until the very end of June, there was a significant decrease in the factors. In fact, it's the biggest decrease in the factors that I've seen since the lump became an option back in 1995. There was a big jump in interest rates. The factors went down a lot. Now, I certainly cannot predict what's going to happen to those factors, for next July, and I don't think you can either. If you have a crystal ball with the economy, please share it with me. I would love to know. But the reality is the staff at the Pension Fund Office does not know what's going to happen next July with those factors. Okay. So I have a couple of examples that we'll look at of calculations of the partial lump and of what happens to the monthly benefit when the partial lump sum is elected. Okay, so we're going to go back to our initial example of a retiree who's 60 years old with 49 and a half years of pension credit. And if you remember, or if you printed the slides, the initial 60 certain amount that we've been working with, the initial single life annuity with 60-month guarantee amount that we've been working with is $6,187. So on your personal estimate from the portal, you can see your monthly benefit amount. 10% of your monthly benefit amount is calculated. So in this situation, 10% of that monthly amount is $618.75. And then the estimate programming pulls the actuarial factor. So in this particular example, the actuarial factor for the retiree who's 60 years and 0 months old is 177.2180. So the lump sum option, the partial lump sum option amount for this particular carpenter is a partial lump sum amount of $109,653. So if the carpenter chooses, you can take a partial lump sum up front of $109,653, and we'll talk about what you can do with that lump sum as far as, rolling it over or paying it direct to you. We'll talk about that in a subsequent slide. Let's just look at the numbers for now. But if the carpenter does that, if the carpenter takes a partial lump sum option, then the monthly benefit amount that the carpenter will receive will be a lesser monthly benefit amount because part of that pension amount has been converted to the $109,000 lump sum payment. So instead of receiving a monthly pension benefit of $6,187, the carpenter will receive a monthly pension benefit of $5,568 a month for the carpenter's lifetime. Now, the joint and survivor options are also available with the partial lump sum option. And they work exactly the same way as the joint and survivor options if the lump sum is not taken. So all of the provisions that I've already discussed about the pop-up feature and a pop-up after divorce and the potential for assignment to a spouse after a divorce and the 60-month guarantee being built into the joint and survivor on the construction plan, all of those options work exactly the same. What changes here is the monthly benefit amount. So we take our initial starting place when we calculate the joint and survivor benefits is the $5,568. So the monthly benefit amount available to the carpenter and to the surviving spouse decreases if indeed the partial lump sum payment is elected. Okay. Just to give you an idea of the change that happened in the factors this year, I mentioned the change was significant. The actuarial factor for the last fiscal year, which is July of 2021 through June of 2022, when I did this presentation in the spring, this actuarial factor here for the last fiscal year for someone who was 60 years old was 209.0647. So you can see that was a pretty big decrease in the actuarial factors this year. Some questions coming through the chat. So let me take a look at those, and then we'll talk about payment options on the lump. How long does one have to be married in order to sign up for any of the joint and survivor benefit options? So to sign up for any of the joint and survivor benefit options, you just have to be married the day before your pension starts. Okay, so you can go down to City Hall on October 31st and get married, and joint and survivor options can be effective for November 1st. Now, you still have to apply for pension 2 months ahead of time, and we'll talk about all of that, but the reality is you can pick a joint and survivor option if you are going to be married at least the day before your pension starts. However, in order for that joint and survivor benefit to actually end up payable, you and your spouse have to be married for at least 1 year at the time of the carpenter's passing. So in my example, somebody goes down to City Hall, gets married on Halloween on October 31st. Pension starts on November 1st under, say, a 75% joint and survivor option. As long as the carpenter is still with us, as long as the carpenter does not pass away for 1 full year, the surviving spouse receives the surviving spouse's under the joint and survivor, just like I've discussed up to this point. However, if the carpenter were to pass away before a full year has passed, the benefit turns into a a single life annuity with 60-month guarantee, and the spouse, who I would assume was named as a beneficiary, would only receive the 5-year guarantee benefit. An adjustment would be due for any monthly payments made already. So if that's your situation, maybe give the staff at the pension fund a call, and they can talk you through that in a little bit more detail. Is there ever a cost of living increase or a 13th check? Yes, indeed, there have been increases and there have been 13th checks. The Board of Trustees decides those on a year-to-year basis. Okay, so there's nothing guaranteed as far as a cost of living increase, like a Social Security. There's a COLA built in every year. In fact, next year, Social Security recipients, it was just announced a couple of days ago, they're going to get, I believe, an 8.7% increase for next year. So we don't have anything like that built into the plan. But from time to time, the Board of Trustees issues either a bonus payment or grants an increase. So in this year, in March of 2022, in the construction fund, there was a bonus payment. It was a formula bonus payment, and it was specifically designed to give those who have been retired longer, maybe with lesser monthly pension benefits. So they retired maybe back when the accrual rate was $60 or $40 or $88. So the formula was you got $75 for every year that you had been retired and receiving a pension benefit, plus $21 for every year of pension credit that was involved in your pension calculation. So it's a formula bonus. There have been formula bonuses. Prior to this year, there was one in 2018. In 2017, there was a bonus check, what some people call a 13th check. It was equal to 1 monthly payment. In 2019, there was a permanent increase, a percentage increase, and the percentage that was granted was based on how long someone had been retired. Again, designed to give those who retired many years ago who get a lesser monthly pension benefit a greater increase. So if you retired prior to 1999, you got a 10% increase. Between 1999 and 2004, you got 6%. Between 2005 and 2009, you got 4%. Between 2010 and 2014, it was a 3% increase. And then anybody who had retired between 2015 and 2019 got a 2% increase. So yes, there have been increases and bonuses, again, decided by the Board of Trustees on a month-to-month basis. Let's see. What goes into determining the actuarial factor itself? So high-level overview, because I am not an actuary or an accountant, things such as life expectancy, earnings performance by the plan, interest rates issued by the federal government, time value of money. So there's all kinds of things that go into that. I'm sorry I cannot give you a more detailed answer on that, as I am not an actuary. Almost done. I'm trying to read the last one. Again, a question about federal taxes. Who takes out the taxes? Well, the pension fund office takes the taxes out of your monthly check, and we send it to the IRS. We send the money to the IRS, just like the withholding on your paycheck. You know, your employer holds the money and sends it to the IRS to credit against your taxes. The pension funds holds the money. The pension fund office holds the money out of your pension check, the federal income tax money out of your pension check, and sends it to the IRS so that it's, there basically in your account with the IRS when you file your taxes for for the upcoming year. You will be issued a 1099-R form in January, which is the equivalent of a working person's W-2 form. So you use that when you file your taxes. It'll show the amount of your monthly pension benefit, and it'll show the amount that the pension fund held back for federal taxes and sent to the IRS, so that you or your tax person can use that form when you file your taxes the next year. Okay. That's all I see coming through the chat right now, and I'm going to move on so that we have ample time to get through. There's still a lot of presentation to go. Okay. So the presentation itself, we're still talking about that partial lump sum option. So if you choose to take the partial lump sum option, you need to decide what you're going to do with that partial lump sum option. And no, I don't mean, are you going to go take a trip to Vegas, or are you going to take a cruise, or are you going to buy a car, although those are certainly decisions you need to make. What I'm speaking of here is, how are we going to pay that partial lump sum to you if indeed you elect to take it. Okay. So we can make payment directly to you, the carpenter. You would get that partial lump sum check the first of the month in which you get your first pension check. If we make payment directly to you, the retiree, we are required to hold back 20% to credit against your federal income taxes. We will, of course, send that 20% to the IRS, so the IRS has that on your account when you file your taxes next year. This is similar to withholding on your paycheck. Okay. And it is very important here at the bottom of the slide, please understand that I am not telling you that the lump is taxed at a 20% rate. The lump is taxed at whatever your personal income tax rate is. So if you fall into a bracket that makes you pay more than 20%, or a bracket that makes you pay less than 20%, that's fine. That happens when you complete your tax return for the IRS. What I am telling you here today is that we are required to withhold 20% and send it to the IRS if that lump check is paid directly to you. I am not telling you that the percentage rate of tax is 20%. So please be aware of that. Okay. So we can make payment direct to you. You will declare it on your income taxes for the year, if indeed we pay that directly to you, and it will be taxable income for you during the year. So something to think about if you are going to retire, especially toward the end of the year. And this could be something that you should think about talking to your financial planner or your tax person about. If you're going to retire toward the end of the year, and if you have had active working income for the whole year, and perhaps you are married and maybe your spouse also works outside the home and your spouse also has income for the year, whatever you're used to paying in taxes, whatever you're used to declaring as your gross income on your federal taxes, if you elect to take this 10% partial lump sum payment, in our example here of $109,000, that's going to add $109,000 of taxable income, onto your gross income for the year. So what impact will that have on your tax rate? Is it going to throw you into a higher bracket or not? So something just to think about, something for you to talk to your financial planner or your tax advisor about. I am in no way telling you not to have this paid directly to you. I'm just giving you something to think about here. So other options as far as the partial lump, as far as paying the partial lump, you can do a direct rollover. Okay, and there are two different types of direct rollover. You can do a direct rollover to a traditional IRA or other qualified retirement plan of your choosing. And you can even do a direct rollover of your 10% partial lump on the pension into your John Hancock Supplemental Retirement Plan account if you choose to do so. If you do a direct rollover, your benefit, the 10% partial lump sum option, is not taxed in the current year. Okay, so it would not be taxed in the year in which you receive it. It's taxed as you withdraw it from your IRA or retirement plan or your supplemental retirement plan account. So in our example of $109,000, the carpenter rolls that $109,000 into a traditional IRA at the financial institution of his choosing, of your choosing, and doesn't make a withdrawal on it this year. That's fine. It just sits in the IRA at the financial institution of your choosing, and maybe you start to do some withdrawals, the following year. But then that way, doing a rollover, it does not get added onto your taxable income for the year. Okay. The second rollover option is to a Roth IRA. So I don't know whether or not you're familiar with Roths. I only have a basic understanding of them, but a Roth IRA is a post-tax vehicle. So if you roll the partial lump sum amount into a Roth IRA, it is still taxed in the current year. The fund office here is still required to hold 20% from it, but it is not taxed as you would make withdrawals from the Roth IRA. Okay, so some things to think about. We try to point out that your supplemental retirement plan at John Hancock is indeed a rollover option. So you can roll that money into your supplemental retirement plan at Hancock and then, withdraw as you see fit. The fees that the fund has negotiated with our partnership with John Hancock, you might find that they're considerably less than some fees at some other financial institutions that you may be considering. So while I am not advising you to roll it to your Hancock account because we do not advise, I am asking that you and your financial planner consider Hancock as an option for you because it benefits you with the lower fees that are available through the John Hancock Supplemental Retirement Plan. But you certainly do not have to send it to John Hancock. It can go to any financial institution of your choosing. A question that was actually emailed in before the presentation asked if the lump sum payment was chosen, does the IRA at the financial institution of your choice need to be established prior to submitting your pension application? We do not need an account number. We can issue that lump sum check to the financial institution of your choosing just under your Social Security number, and your financial institution can set up the IRA, when they get the check. But you probably want to be talking with someone at the financial institution of your choosing, to do some groundwork, get some things set up, let them know that the money is coming. So, a check made out to the IRA for your benefit doesn't just show up at your financial institution one day and nobody knows what to do with it. A couple more questions coming through the chat. And Thomas and Dave, those are both questions that I'm going to answer later in the presentation. Okay, so any questions that you'd like to put through the chat regarding any of the payment options, the single life annuity with the 60-month guarantee, the 50%, 75%, 100%, or the partial lump sum payment option here. And as I give you a chance to type, I am also going to mention that under federal regulation with respect to the payment option you're going to choose, the single life annuity versus a 50 versus a 75 versus 100% joint and survivor option, the federal government mandates that if you are married, you choose at least the 50% joint and survivor option unless your spouse will sign a consent form to allow you to take the full single life annuity payment all to yourself. So that is a federal regulation that the plan must comply with. Additionally, on the 10% partial lump sum option, if you are interested in that partial lump sum option, and if you are married, your spouse must also consent to your taking that partial lump sum option as a benefit to you. don't see anything else coming through the chat, so I do want to mention one more thing that I'm realizing that I forgot about, and I'm going to back up my slides here just a little bit, and I apologize for this. I forgot about this. So in our example here of the $109,000 lump sum option, and on your personal printouts that you downloaded from the portal, what you see there is the maximum 10% partial lump sum option that is available to you. Some people look at the lump and they think, well, yeah, I would like to take part of my pension as a lump sum up front. I want to maybe pay off the credit cards and finish paying off the car. And, maybe I have a home equity line of credit. I'd like to get those things all paid off and start retirement with a fresh, clean slate and not owe anybody anything. But it's not going to cost me, in this example here, it's not going to cost me $109,000 to do that. It's only going to cost me $30,000 to do that, or $50,000 to do that, or whatever your personal situation might be. The estimates from the portal download at the max 10%. You can choose to take a lesser lump sum. So maybe instead of the full, in this example, $109,000, you only want $30,000 or $60,000 or $70,000. You certainly can do that. You can take a lesser lump. The minimum is $1,000. Okay. The less of a lump you take, the more you're going to get on your monthly check. The less of a lump you take, the more you're going to get on your monthly check. And the participant portal lets you play with those numbers. If you go out to the portal where you picked where you downloaded your estimates, one of the options there, you probably clicked a button for the 10% option. There actually is a line there on the portal that you can type in, the 30,000 or the 50,000 or the 70,000 or whatever number you're thinking of. And the estimate that will generate for you then will show you your adjusted monthly benefit amount if you take less than the maximum partial lump sum option. Okay. So I do apologize for forgetting to mention that while we were on that prior slide. So I'm going to just move the slides and catch us back up to where we should be here. The one question did come through: is the partial lump sum option available to both mill and construction pension participants? And the answer is yes. I also would like to mention, if you have credit with both the construction fund and the Millman fund, you really should consider coming into the office, making an appointment, coming into the office and talking to a pension representative on a one-on-one basis. For those of you who have earned credit in both of the pension funds, you have a few more different payment options and a few different things that impact your benefits. So if you are someone with credit with both funds, please strongly consider making an appointment and coming in to talk to a pension representative. Again, we don't advise, but we could certainly explain your payment options to you on a one-on-one basis. We have appointments available at both the downtown Chicago office. I guess we're not downtown, we're really in River North at the Chicago office. And we also have the satellite office out in Lisle. The satellite office out in Lisle, the fund representatives are there on Tuesdays and Thursdays, but you must call and schedule an appointment, especially for that Lisle office. We have more limited staff out in the Lisle office, and those Lisle appointments go pretty quickly. And you don't have to necessarily have credit with both construction and mill to come in. If you still have questions after the presentation today, or if indeed you want to apply in person, please feel free to come in and meet with a member of the retirement benefits staff. We're more than happy to spend time with you on a one-on-one basis. Again, I just want to emphasize that you want to call and make an appointment to do that. Okay. Okay, that's all I see coming through the chat right now. So we're going to move on, and we're going to talk about something called a level income option. And as soon as I get through the level income option, then we will take a break. Okay, and the level income option, I'm going to get through and explain here. And I think I'm going to go through this a little bit quickly. It's been in place since 1996, and it is not at all a very popular option, but we do want to try and make sure that everyone is aware that this is an option for the construction pension plan. This is not currently an option available under the Millman pension plan. Okay, so the level income option allows a participant, a member, to receive approximately the same monthly pension for lifetime if you start your pension before you start your Social Security. And it takes into account both your pension from the plan and your Social Security benefit from the Social Security Administration. It is only available to the construction plan. And if indeed you are a construction plan participant, in order to take advantage of this option, you have to be at least 60 years old and have at least a quarter year of credit in the year in which you retire or within the 3-year period before starting your pension. You cannot take both the lump sum option that we just talked about, or the partial lump sum option, and the level income option. It's one or the other. So let's look at the examples that I have here in a moment. If indeed you're interested in the level income option, after I explain it on the next couple of slides, you would have to provide the pension fund office with a copy of your estimate from the Social Security Administration. So you can do that by calling Social Security, in which case you're probably going to sit on hold for a considerable amount of time, or you can go to My Social Security, SSA.gov, and you can log in and to your own personal Social Security account. If you have not yet established an account, it's very easy to do so. It probably took me 5 minutes to set up my account a couple of years ago, but you just go out on the web to SSA.gov. You can request an estimate of your benefits, and you can download it and print it, just like you could on our participant portal for your pension benefit estimates. If for some reason you need a replacement Social Security card, you can request that there. And then once you are receiving Social Security, you can set up or change your direct deposit. You can get a benefits verification letter. You can do all of those types of things on the Social Security website. So the actual example of what a level income option is. So I have another example slide. This retiree's age 60, and she has worked for calendar years 1985 to 2021, which is 37 years. And over that 37-year period, she's earned 42 years of pension credit. So we first do the base calculation. We take the 42 years of credit, we multiply by $125, and we get the single life annuity 60-month guarantee amount of $5,250. She furnishes the pension fund office with a copy of her Social Security estimate that she got at SSA.gov. And that Social Security estimate shows a monthly Social Security benefit of $1,200 a month at 62. Remember, she's only 60 now, so this is saying at 62, she'll draw $1,200 a month from Social Security. So again, just like the lump sum factors, we have another set of tables that are level income factors that the actuaries come up with. So we take the $1,200 Social Security benefit, we multiply by the level income factor of 86.87% or 0.8687, and we get a level income amount that would be payable from the pension fund of $1,042.44. So the way this works then, next slide here, is we take the 60-month guarantee amount from the pension fund that we calculated on the last slide, and we add to that the $1,042 amount that we calculated off the $1,200 Social Security estimate, and we come up with a monthly benefit of $6,292 that would be payable to this particular retiree when she first goes on pension. On a monthly basis, she'll draw $6,292.44 instead of the $5,250 a month that she would be entitled to just on her pension benefit alone. Sounds pretty good, right? Hey, extra money, sign me up. I'm all for extra money. But as we all know, there's no free lunch in this world. So, what happens once Social Security kicks in is that the total benefit from the pension fund that she has received from age 60 all the way up to 62, she got this 62.92 every single month. But once Social Security kicks in, we take the 62.92 and we subtract off the full $1,200 a month that she's going to get from Social Security. So her benefit from the pension fund decreases to $5,092 a month. And that is a permanent decrease for the rest of her lifetime. But her monthly income remains level, which is why it's called a level income option. Before Social Security, the entire $62.92 a month was coming from the pension fund. After Social Security, she's still getting $62.92 a month. It's just $1,200 is from Social Security and $5,092 is from the pension fund office. So her income stays level, but the amount payable from the pension fund office goes down, okay, to account for the fact that Social Security has now started. So that's how the level income option works. You cannot run a level income estimate off of the portal because the pension fund office needs you to send us a written copy or a downloaded copy of your estimate from Social Security. So if indeed you are interested in this option, you can submit to, or you need to submit to, the pension fund office that Social Security estimate, and then we in turn will generate that level income option and send that to you. Now, this can all be handled through email. You can email your Social Security estimate in, and we can email those level income estimates back to you. Our email address is in the handouts, in the pension handouts on page 2. There's a contact page. But our email address is retirement@Carpenter Benefits. So Carpenter is singular, no S, and then benefits is plural. So retirement@carpenterbenefits.org is the email address here at the pension fund office if you'd like to send in the Social Security estimate to see these figures for yourself. Again, it's not a very popular option. It's been available since 1996. And maybe a couple hundred people have taken it. Now, maybe a couple hundred sounds like a lot to you, but when you consider that on a monthly basis, we put anywhere from 75 to 100 people on pension every month, that it's not a lot of people who have actually taken this option. Okay. So we are at our first break. So during the break, if you have questions, put them through the chat and we'll circle back to any questions you have after the break. It's 10:33 right now. So why don't we come back at 10:45? Okay. So I will start talking again at 10:45, and in the meantime, I will look at any questions you have come through the chat. We will take one more break, but our second break will only be like a 5-minute break so that we can get through the material. Okay? I'm going to start talking right now, and I will start talking again at 10:45. Thank you. Okay, we're back. Hope you got everything you needed to get done during that break. I want to talk a little bit about disability pension. Um, Before we do that, a couple questions came through on the chat. For the two gentlemen who say they have credit in another area of the country, please give the pension fund office a call at your convenience. Let us know where you have your other credit so that we can write to that other fund, send them a copy of your credit with Chicago, and determine eligibility for benefits that way. Someone also asked, do a lot of people take the partial lump sum option? And while not a lot of people take the level income Social Security option, quite a few people take the partial lump sum amount. I would say maybe about 60% of the retirees take that partial lump sum option. Um, certainly nothing that you have to do. You are welcome to say no to that and just go with the regular straightforward pension if that suits your financial situation better. Again, I want to mention you might want to talk to a financial planner with respect to retirement. While the Retirement Benefits Department staff is certainly happy to answer questions about how your benefits work, we are not allowed to advise on, what might the best option be for you. We're also not able to offer tax advice as to what you should do about your withholding options. So think about talking to a financial planner or a tax advisor about things like that. Okay. So disability pension. In order to receive a disability pension, there are requirements as to disability itself, and then there are credit requirements. So I'm going to look at both of those. Participants will be considered disabled if they're unable to engage in any substantial work, not just carpentry. Substantial work is work that is either physical or mental work. So a desk job would qualify for something that would be considered substantial gainful activity. So it's not enough to be disabled from working as a carpenter in order to qualify for a disability pension. To meet the definition of disability, you have to be disabled for any type of gainful activity at all. Along with that, there are different requirements under each pension plan as far as pension credit goes. So under the construction plan, you need to have at least 15 years of pension credit, or if you don't have 15 years of pension credit, you need 10 years of pension credit minimum, as long as you earned at least a quarter year of credit in the calendar year in which you became disabled, or in one of the immediately preceding 5 years. The Millman plan is slightly different. You need at least 10 years of pension credit, and you must have earned at least a quarter year of credit in the year you became disabled, or one of the 2 immediately preceding calendar years. So in order to prove disability, required documents would either be a Social Security Disability Award letter. So if you have Social Security benefits under Title II of the Social Security Act, then you have a Social Security Disability Award letter. That would be submitted to the pension fund office as proof of your disability. Or if you do not yet have Social Security disability, you can still apply for a disability pension, but then you need to submit medical records substantiating your claim of disability. The medical records are sent to an outside independent medical consultant to review, and the medical consultant will determine for the fund whether or not you are disabled for any substantial gainful activity. The pension fund office staff does not make that determination. We send the medical records to an outside medical consultant. Now, if you already have Social Security disability, then there is no need to submit medical records. Okay, we don't need both. Okay. So payment options on a disability pension. On a disability pension, no matter what your age, there is no early reduction factor. So there's no age penalty or age reduction involved. So under the construction pension plan, a disability pension is calculated as if you were 60 years old. On the Millman plan, it's calculated as if you were 65 years old. The different payment options as far as the single life annuity with 60-month guarantee, the 50%, 75, and 100% joint and survivor options, those are all available options on a disability pension. Pardon me. The partial lump sum option is available, but the level income option is not available. Under a disability pension, there are specific work restrictions. We will talk about work restrictions on a non-disability pension in some upcoming slides, but right now, as far as the disability pension, you can do a little bit of work if you are on a disability pension, but it cannot be substantial. The whole premise of a disability pension is that you are totally disabled and unable to do substantial work. So you can do a little bit of work in non-carpentry, non-building trade type employment while still receiving a disability pension as long as your earnings aren't substantial. And the pension fund adopts the Social Security Administration's definition of substantial gainful earnings. And in 2022, your earnings would have to be less than $1,350 a month in order to not be considered substantial. So your earnings would have to stay under $1,350 a month at whatever type of non-substantial employment you might want to look into under a disability pension. For example, and for those of you who have attended before, I apologize that some of my examples are the same, but they're true, so of course they would be the same. A disability pensioner who was on the rolls for many years, who actually has since passed away, wanted to get out of the house a little bit, a few days a week. So he literally had a job at McDonald's, and he baked the biscuits at McDonald's in the morning for breakfast. So, that earnings certainly were not substantial. He was still drawing a disability pension from the pension fund, but he was able to, get out of the house for a few hours, a couple of days a week, and, still feel like he was able to contribute something, do something outside of the house. So those are work restrictions on a disability pension. If you are interested in a disability pension, I understand that I am not devoting much time to that today. Please give the team at the Retirement Benefits Department a call. We're here for you. We're here to answer your questions. This retirement webinar today is to give you an overview of all the benefits and really to encourage you to reach out to the pension fund team with any individual questions or with questions about anything that I don't cover in depth today. Okay. So coming through the chat a bit ago, someone asked about pre-retirement death benefits. What happens if you pass away prior to retirement? So a couple different scenarios. First scenario, if you are married at least 1 year at the time of your passing and you are not yet retired, so this is pre-retirement death benefits, married at least 1 year on the construction pension plan, your surviving spouse would start to draw a 100% joint and survivor benefit effective the month after you pass away. And under the Millman pension plan, a surviving spouse would start to draw a 50% surviving spouse amount effective the month after the carpenter passes away. The pension benefit is calculated as if you had gone on pension the first of the month in which you pass away. And if you are not at least 55, if you are not at least 55 in the construction plan, the benefit is calculated as if you were 55. And if you are not at least 60 in the Millman plan, the benefit is calculated as if you were 60 years old in the Millman plan. It is a lifetime benefit for your surviving spouse. Again, it starts the month after you pass away, no matter how old your surviving spouse or how young your surviving spouse is. And it is a lifetime benefit for that surviving spouse, even if that surviving spouse subsequently remarries. Now, if you are not yet married or not married, or not married for at least a full year at the time of death, there are two different types of benefits depending upon your age. So if you are at least early retirement age, and for the construction plan, that's 55, and for the Millman plan, early retirement age is age 60. If you pass away prior to retirement and you are already early retirement age, we calculate what your monthly early pension benefit would have been if you had gone on pension the first of the month in which you pass away. And your beneficiary, your designated beneficiary, would receive a pre-retirement 60-month guarantee. So your beneficiary would get 60 monthly pension payments. And by the way, 60 months is equivalent to 5 years. I don't know if I've mentioned that today yet or not. So your designated beneficiary would get a 5-year pension paid out to them on a monthly basis if you're at least early retirement age. If you're not at least early retirement age, then there are specific credit requirements. In the construction plan, you need at least 15 years, or if you don't have 15, you need at least 10, with a half year of credit in the year that you pass or the immediately preceding year. And in the Millman plan, at least 10 with a quarter year in the year in which you pass or the immediately preceding year. And it's what's called a death benefit calculation. So it's your years of credit, however many years of pension credit you have, multiplied by a death benefit rate. So the construction plan, it's $875, and the Millman plan, it's $345. So for example, someone in the construction pension plan who is not yet early retirement age and who is not married passes away prior to pension starting, 10 years of credit multiplied by $875 is a total benefit due of $8,750, and that amount is split out over a 5-year period to your designated beneficiary. Post-retirement death benefits, in addition to the monthly pension that we already talked about, that the 60-month minimum guarantee applies, and that it would be a lifetime benefit for a spouse if you take a 50, 75, or 100% joint and survivor. There is also a one-time lump sum death benefit payable when the carpenter passes away. So that's a $3,000 benefit from the construction plan or a $2,000 benefit from the Millman plan. Now, if you are a participant who has credit with both the construction plan and the Millman plan, and you're going to draw a pension benefit from both of those plans, you will not receive $5,000, but you do receive the $3,000 benefit. So you receive the greater of the two benefits. For those of you who are currently eligible for the active working carpenter medical benefits, you have a $50,000 life insurance policy while you are eligible for the active working carpenter medical benefits, and that's through Hartford. It used to be through Aetna, but it's a $50,000 policy. That $50,000 benefit goes away when your active medical eligibility ends and you move on to the retiree medical benefits. But provided that you take the retiree Blue Cross Blue Shield benefits, which we will definitely talk about in some detail later in this presentation, but as long as you are electing to enroll in the retiree Blue Cross Blue Shield benefits, you will have, and you are younger than 65, you will have a $25,000 life insurance policy through the Hartford up until the point in time you reach 65. The fund office pays the premium for that. Once you reach age 65, you have the option to convert that $25,000 policy into a self-pay policy directly between you and Hartford. So the life insurance under the retiree plan of health benefits only runs up until you reach age 65, or at least is only sponsored by the fund office up until 65. If you want to continue it past 65, you would have to pick it up on a self-pay basis directly with Hartford. So I'm still watching the chat. I don't see any questions coming through, so please remember that the chat is still there for any questions that you might have. Okay. So we talked about disability, we talked about post-retirement benefits, and as long as we're talking about death benefits, let's talk for a moment about designating beneficiaries. So on the portal, you are able to see the latest dates of your beneficiary designation. And by the way, the QR code up on the screen, if you did not register for the portal prior to the presentation, you can scan that QR code on the screen, and it will take you to the portal so that you can register. But on the portal, you can see the date of your most recent beneficiary designation. So on the left-hand side, you would select My Beneficiaries, and then you can see the date you assigned a construction pension fund beneficiary, if indeed you assigned a Millman pension fund beneficiary, and then the supplemental retirement plan beneficiary, the John Hancock beneficiary. So you can see those dates on the portal. If you see the word none, like in this example under Millman plan, none means you do not have a beneficiary on file for that particular fund. So one of the most important things that you can do is designate a beneficiary for your pension benefit for any benefits that may be payable upon your passing. The handouts for today contained beneficiary forms for both the construction and mill pension, the supplemental retirement plan, and even for the active $50,000 life insurance policy through Hartford. So if you look on the portal and you don't see a beneficiary designation date, or if you think to yourself, well, gee, that date shows I designated a beneficiary back in 1997, and since then I got married or I got divorced or we had kids, then you should think about updating your beneficiary on that beneficiary form. You need to complete a beneficiary form, have it on file with the fund office prior to your death in order for that beneficiary form to be valid and acceptable. You may choose more than one beneficiary, and you may name contingent. Contingent means secondary, a contingent beneficiary, in case your primary beneficiary passes away before you. You don't necessarily need to panic if you don't have a beneficiary form on file at this time. It is certainly important, and I would definitely encourage you to do that, to get a beneficiary form completed and on file. But if you are married and don't have a beneficiary form on file, we have an order of succession in the plan, and we'll talk about that on the next slide. But if you're married and you pass, your spouse is automatically your primary beneficiary. Your spouse must automatically be your primary beneficiary if you are younger than early retirement age. Once you reach early retirement age, if for some reason you want to name someone other than your spouse as your primary beneficiary, you can do so, but your spouse needs to fill out a spousal consent form in order for that to happen. Okay. So if you have the handouts, you can see that the forms are 2 pages for each of the beneficiary types. What I'm looking at now is called the Defined Benefit Pension Plan Designation. Defined Benefit Pension Plan Beneficiary Designation Form. I got the words backwards. Sorry about that. The forms are 2 pages. The first page of the form gives you a place to name a primary beneficiary. So most of you who are married, I would imagine you want your spouse to be on that first page of the form as your primary beneficiary. And then on the second page of the form, you want to name your contingent. You want to name your secondary beneficiaries. So if you are not married and you want to name a beneficiary, more than one beneficiary, there are indeed 3 separate lines on the first page of that form that you can name multiple people to split your benefit as your primary beneficiary. But again, if you are married, you really only want to use one of those lines to name your spouse as your primary beneficiary. Okay. Something I like to mention during the webinars and even back when we were doing in-person seminars, if you have children and you want to name your children as your secondary beneficiaries, or if you have children and you're not married and you're naming children as your primary beneficiaries, just something to think about. You might think, Oh, well, I'm going to name Billy. I'm just going to name Billy as the beneficiary, even though Billy's got, a couple of siblings. I know Billy's going to be a good boy and he's going to split that benefit with his siblings. Um, I don't doubt that. I believe Billy's a good boy. I believe Billy is going to split that benefit with his siblings. But something for you to think about is if you name Billy and if we pay the benefit directly to Billy, that payment becomes taxable income all for Billy. The IRS and Uncle Sam aren't going to care that Billy split that benefit 3 ways with Tommy and Susie, his siblings. It's just Billy's going to have to pay taxes on that entire benefit. So if your intent is to have your children equally split your benefit, you want to name your children separately on the separate lines on the beneficiary designation form so that each child pays taxes on his or her own share of the benefit. If you have more than 3 children or more than 3 beneficiaries that you would like to split benefits, you can make an extra copy of the form and name, a 4th or a 5th person should you wish to do that. The pension fund department staff can certainly talk you through any questions you have about that. The second part of that is you kind of never know what's going to happen after you pass away. And I use this example. My dad passed away back in 2010. I have 2 brothers. We get along just fine. My mom had previously passed earlier. And when my dad passed away, there was a little bit of tension between myself and my brothers as far as, who was going to get what and who was going to get the grandfather clock and who was going to get the china and, who was going to get this benefit instead of that benefit. So we worked it all out in the end. We're still one big happy family of brothers and sisters, but there's some unexpected tension sometimes. So you never know what's going to happen. So again, if it's your intent to have the kids split benefits, list them all separately. Then we do have an order of succession built into the plan if you pass away without a designated beneficiary. So first would be a surviving spouse if you're married. If you're not married or if your spouse had predeceased you, then the order of succession would be surviving biological or legally adopted children in equal shares. If you don't have any children, then it would go to your surviving parents in equal shares, if any. And if your parents are no longer with us, then we would look to who you named as your beneficiary for your active life insurance policy, that $50,000 policy you have while you're actively eligible for benefits with the health fund. So that's the order of succession and beneficiaries. Question coming through the chat. Is there more information concerning the life insurance? I mentioned something through Hartford. Yes, there is more information available on the Hartford policy. In the handouts, in the health fund handout, I have some information in there about the retiree Hartford policy on. Looking to see if I can find a page. And while I'm looking to see if I can find the page for that in the handouts, I will also tell you that the summary plan description, the booklet describing your benefits for both the retiree plan of benefits, the pension benefits, and the active plan of benefits, the booklets describing benefits also describe the information about the life insurance policies. So the handouts, I apologize, it's in the pension handout, and it's on page P45. P like in Paul, page 45, has the information on the retiree $25,000 Hartford policy. And again, you can look at our website, carpenterbenefits.org, for the summary plan description booklets. Okay, I don't see anything else coming through the chat right now on questions. Also, certainly remember, you can give the fund office a call. We're happy to help with questions over the phone. Okay. So quite a few questions came through on the break and earlier in the presentation about applying for benefits. And I didn't answer them at the time because I knew I had a couple of slides to talk about this. So people always ask, when should you request and file a pension application? Okay, a pension application packet is only valid for 6 months. Okay. Our recommendation is that you give the pension fund office, the retirement benefits department, a call 5 months ahead of time, 5 months before you want to retire, in order to get a packet. Then we suggest you complete that packet and submit it to the retirement benefits department approximately 4 months in advance of the time you want to retire. That ensures that everything will go smoothly, or helps to ensure that everything will go smoothly. You have plenty of time to get the paperwork. You have plenty of time to look it over and complete it. The application itself right now is about 14 pages long. There's a lot of different elections to make, a lot of different questions to answer. You need to tell us what payment option you're going to choose. You need to let us know whether or not you're interested in that partial lump payment or the level income option. There's also information in those pages about the things we talked about earlier about the lump sum, the partial lump sum, about paying it direct to you versus rolling it over, and how that's taxed. So there's a lot of information in the packet. Additionally, you need to think about finding, locating, requesting copies of your certified county birth certificates for you and your spouse, and a county certified marriage document. We will need copies of those to process your benefits. So if you contact us ahead of time, reach out to us ahead of time, it gives you more time to complete everything. And then once you send that application, that completed application, into the fund office, or you make an appointment and you come in and turn it in person, it gives us time to process. Now, if you are, and I already mentioned what just came up on the slide now, I already mentioned application packets are only valid for 6 months. So if you requested an application packet a year ago, it's no good, and you need to request a new application packet. Okay. Now, I say that this is our recommendation. Shorter time frames are possible under the regulations, and they get really complicated, so I don't want to go into them all on the presentation. We'd literally spend a half an hour talking about all the different time frames that could apply. But if you're thinking, oh my goodness, I want to go on pension January 1st, and look, it's already the middle of October and I haven't done this, I haven't asked for my application 5 months ahead of time. Well, you still have time to do January 1st, but you're quickly running out of time to do January 1st. So if January 1st is your intention, or even February 1st is your intention, I strongly suggest that on Monday or Tuesday, you give the Retirement Benefits Department a call and request that we send an application packet to you. We can send an application packet through email, okay, and that can usually happen with the day you call, or maybe even the day after. Or we can send out an application packet to you through the postal system, through the mail, through the post office. If we're going to email you the application, please know that you need to have a printer at home, because you need to print the application in order to fill it out and send it back to us. We are moving toward online applications. We hope to be there within maybe the next year or two, but we're not there yet. So right now it's still, pen and paper. You have to fill out an application on paper and get it back to us. Again, submitting that application, we are open. You can make an appointment at either the Chicago office or the Lisle office. Well, you can certainly come in without an appointment just to drop off paperwork. Like if you want to come in and hand our receptionist an envelope with your completed application, that's perfectly fine. You don't need an appointment for that. But if you want to come in and meet with one of the retirement benefits representatives to go over your application, make sure everything's completed properly, talk about any questions you might have about any of the payment options or how anything works, for that, an appointment is indeed required. I know I already mentioned this. The Chicago office is open. We also have the Lisle satellite office. I just want to emphasize again, the appointments at the Lisle office, they're only on Tuesdays and Thursdays, and they are much more limited. So if you're interested in Lisle, try and schedule that appointment as far in advance as you can. We can schedule appointments up to 2 months in advance. Okay. So just one more shout out. If you're thinking you want January, please, please, please give us a call right away for that application packet and get it completed and back to us as soon as possible. Okay. still on applying for benefits. Tom, I see your question, and I'm going to answer that in just a minute. As far as applying for benefits, there's something called an effective date and an award date. So the effective date is the date you're first entitled to benefits. Okay. You have to receive your pension application packet from us. And I told you I don't want to go into a whole bunch of details, but you have to get the pension application packet from us at least 7 days before the first of the month in which you want to start. And you have to apply by at least the last day of the month before you want to start. So just keep in your mind, I guess, that you need to apply at minimum, and this is bare bones minimum, say 2 weeks in advance of the first of the month in which you want your pension to start. All of the pensions start on the first of the month. There is no such thing as a pension starting on the 8th of the month or the 20th of the month or the 15th of the month. Pensions always start on the first day of the month. So after we determine your effective date, that's the date you're first eligible for benefits. Usually it could be the month after you apply, as long as we've sent you an application packet at least 7 days in advance under these kind of crazy rules that the government has out there. But you're applying for benefits on, say, October 15th or October 20th and wanting your pension to start on November 1st, well, you might be entitled to November pension money, but there's no way we're going to be able to cut you your first pension check on November 1st. It is going to take us at least 60 days to process and issue your first pension check. Okay. In some cases, that first pension check can be retroactive. So if you come into the office this coming Monday with an appointment, so you call Monday morning and you get a Monday afternoon appointment. I'm not looking at the schedule now. I don't know how full we are on Monday, but just for example, you come in this coming Monday, which is October 17th. You have time. You can be eligible for November 1st pension money. Okay. But we are already done processing November 1st pension applications. So there's no way you're going to get a check for November 1st. Instead, what you would have probably would be either a December or a January award date. And the award date is the date we issue your first check. So when you get that first check on your award date, if again you're coming in on Monday and applying, that first check could be retroactive to include, say, the November payment or the December payment, but we're not going to be issuing you a check with a super quick 2-week turnaround. It doesn't happen. We need time to process here in our office for the representatives, and each and every pension application is reviewed by an outside auditing firm to make sure we've done the calculations correctly and we have all the paperwork and supporting documents that we need. So that's effective date versus award date. If your award date is later than your effective date, your first check will include any retroactive payments that may be due to you. So in addition to the pension application itself, there are required documents. Copies are acceptable. Okay, we used to require originals, and during the COVID period, while we were on work from home and people couldn't come into the office, we switched to accepting copies, and we have kept that requirement. So copies are acceptable. We need a copy of the Carpenters County Certified Birth Certificate as a proof of age. If you don't have a county certified birth certificate, other documents are indeed acceptable. So if you printed the handouts for today, in the pension handouts, page P16 gives you other acceptable documents that you can use as a proof of age, for example, a passport. We also need a county certified birth certificate or other acceptable proof of age for your spouse if you are taking one of the joint and survivor payment options. You need a county certified marriage certificate. So we cannot accept your commemorative certificate from your church or synagogue or from the judge who married you. It has to be an actual county certified marriage certificate. But again, we will take a copy. And we need copies of government-issued photo IDs for the carpenter and if you are married for your spouse. Most common is a driver's license, but a passport would definitely be acceptable as both a proof of age and a photo ID. So if you have a passport, a copy of your passport kind of kills two birds with one stone. So to answer your question, Tom, birth certificates are not needed if you're sending us in a copy of your passport. We can use the passport as both proof of age and as a photo ID. Pension payments are made on the first working day of the month. We pay the month ahead. We don't hold back a month like Social Security does. So the checks that we're going to issue for November 1st for people who are already on the pension rolls and for our November 1st new retirees, the checks issued at the beginning of November are for the month of November. Your first pension check, and if you take the partial lump sum option, those first checks are going to be paper checks sent out to you. But subsequent checks must go direct deposit to your bank account. So it's a mandatory direct deposit starting with your second pension payment. We do not mail out check stubs, but on the participant portal, you can see your check stub and you can see your gross payment. You can see any deductions for federal taxes. And once you move on to retiree health benefits, you can see deductions, any possible deductions for retiree health benefits. You can see all of that on the participant portal. Okay. We already spoke about this, but the monthly pension payment is federally taxable, as is the 10% lump sum, partial lump sum, or even if you take a lesser lump sum, they are indeed taxable income. Your employer contributed to the pension fund in accordance with the employer's collective bargaining agreement, so you have not paid any taxes on the pension money. And of course, Uncle Sam needs to get his fair share. So it is taxable by the federal government. Part of the pension application packet is information that we are legally required to send to you. So if you downloaded the handouts or printed the handouts for today, in the pension handout section, there's something called pension benefit payment options and relative value notice, and a consequences of failing to defer benefits notice. Everything in those notices I've pretty much explained to you today already. It's how the single life annuity with 60 certain months works, and the 50, 75, and 100%, how all of that works. So all of that information is in the handouts for you. Additionally, when you get a pension application packet from the pension fund office, that will also include estimates that look very, very similar to the estimates that you are able to print on the portal. You need to return one signed copy of each of those estimates. Whether or not you're taking the partial lump option, you still have to sign and return the partial lump sum option to us. We have to prove to our auditors that we've shown you that you've reviewed all of your different options before you made an informed decision about how you want your pension benefit to be paid to you. Okay, so there's the application packet. Get that from us. I know I'm saying this for the third time, folks, but really, if you want January or February, please be on the phone this week to the pension fund office to request that packet. You're quickly running out of time for those 2 dates and for processing. Okay. Keeping an eye on the chat. I don't see anything else coming through there. So let's keep going with the presentation. Benefit adjustments is next. So I just mentioned a moment ago that we are done processing November 1st new pensioners, and that is absolutely true. And some people who are wanting to start or who have applied to start their pension for November 1st, they're probably working up through the end of October. So those of you who have been with us for many years, as most of you registered today know, the employer contributions for the month of October won't be due to the fund office until November 15th. So we have essentially already calculated those November 1st new pensioner benefits without including any hours that were already worked or are being worked in October, because we will still get more employer contributions come into the office for the October hours. So approximately 3 or 4 months after your pension starts, the Retirement Benefits Department goes back through everyone's record, and we see if any additional hours have come in. And if additional hours have come in that were not already considered when your initial pension was calculated, we recalculate your pension benefit amount, and you receive retroactive money for any additional amounts that may be due to you for those additional hours and credits. The full adjustment is made to your monthly pension benefit, so there is no adjustment made to, say, a partial lump sum benefit if indeed you've taken the lump. So, for example, some extra hours, John goes on pension for November 1st, and he had 42 and 3/4 years when we calculated his benefit for November 1st. But then his October hours come in, and there's enough hours to give him another 1/4 year of credit. So we processed him with 42 and 3/4 credits, and now he's got 43 credits. And of course, we want to make sure he gets everything that he's entitled to. So 2 or 3 months after his pension starts, so his pension starts November, December, January, probably for February, we recalculate his benefit to include that extra 1/4, which in most cases comes out to be $15 a month, $18 a month extra, depending on your age when you retire and whether or not you've taken a spousal option. So we increase your monthly benefit by that, $15, $18, $20, whatever the calculation comes out to be for that extra credit. And then we also give you the back money for that, little bit of $15, $18, $20 for November, December, and January, all on your February check. Okay. No adjustments made to the partial lump sum amount. As I mentioned, the full amount is adjusted onto the monthly benefit. There are some instances, and we're going to talk about working after retirement and prohibited employment, what you can and can't do, but there are some circumstances where individuals who are at least 65 years old can still be working and possibly earning pension credit after retirement starts, after your pension starts. So those adjustments for any extra credit earned are made on an annual basis. Okay. Still don't see anything coming through the chat there for questions. I see a couple people have dropped off. If you need to drop before the end of the presentation, please remember that this is being recorded and will be posted to the Fund Office website. And actually, the prior pre-retirement webinar presentation is currently out there right now. Okay. So let's talk about working and not working and prohibited employment and what you need to do as far as stopping work in order to be eligible to start your pension. This is in the pension handouts. It runs from page P46 to P49 in the pension handouts. But in order to start your pension, IRS regulations require what's called a legitimate severance of employment. So this means that there's a two-part criteria. You have to stop working in any capacity, not just as a carpenter, but in any capacity with any employer who is signatory to the pension fund. And you cannot have any intent of returning to employment with an employer who is signatory to the pension fund. And then part 2 of the test, the severance test, is that you may not be working in any type of prohibited employment for any employer at all, even if that employer is not signatory to the pension fund. So let's take 2 different examples. On the first one, you have to stop working in any capacity for a signatory employer. So you cannot just stop working for signatory, Carpenter, let's even say a big name company, a big name employer. You can't be an employee of Pepper Construction, working with the tools and decide, okay, I'm going to stop working with the tools for Pepper Construction, but I'm going to go and just drive a delivery truck for Pepper Construction. Well, driving a delivery truck certainly is not prohibited employment. You're not working with the tools. You're not doing anything in any way, shape, or form that really utilizes the skills or knowledge that you learned and utilized over your career as a carpenter if you're just driving a delivery truck. But you're still working in a different capacity for a signatory employer. So you cannot do that. You have to stop working entirely for any employer who is signatory to the pension fund in order to start your pension. Also, you cannot work in prohibited employment even for a company who is not signatory to the pension fund office. So you can't go be a carpenter working with the tools, or you can't go be a project manager, or you can't go be a superintendent for a non-union company. Okay, those things, those physical activities are considered prohibited employment. So even if the company is not signatory, you cannot do those types of employment while you are drawing your pension benefit. Okay. Couple of questions coming through the chat about what is and what isn't prohibited. I have some slides on that, so I'm not going to answer those right now. We're going to look at them in just a moment. So another question that gets asked a lot is, if I stop working now, do I have to apply for my pension? And the answer is no. You can wait. You do not have to apply for and start getting your pension benefits until you reach something called required minimum distribution age. Okay. And for people, for most of you in attendance today, for individuals born after June of 1949, I believe it is, which most of you attending today were born after June of 1949, you don't have to start drawing your pension until the April of the year after you reach 72. So if you reach 72 in 2023, anytime in 2023 you reach 72, you would have to start drawing your pension as of April of 2024. So under federal regulations, they're called required minimum distribution rules. You have to start drawing your pension the April of the calendar year after you reach age 72. If there by chance is someone here listening today born before 1949, then your requirement is the April after the year in which you reach 70 and a half. Okay. So you don't have to start drawing your pension right away. So sometimes people want to talk about a legitimate severance of employment. So for a legitimate severance of employment, you need to stop working without an intent to going back. So a prearranged termination and a subsequent rehire, kind of a wink, wink, nudge, nudge type of agreement with your employer, does not count as a legitimate severance of employment. So it can't be that you have a conversation with your boss, Bob, and you say, hey, Bob, I want to start drawing my pension from the Carpenters, and I'm working right now as a draftsman, so I'm not working with the tools anymore, but I'm still working for your company. So, hey, Bob, what I'm going to do is I'm going to quit, Bob, and I'm going to go on vacation for a month or two, down to Arizona. Excuse me. And then in 2 months, I'm going to come back and, hey, Bob, you're going to rehire me, right? I'm still going to be a draftsman with your company because that'll allow me to draw my pension. And the answer to that is no, that doesn't allow you to draw your pension because it's not a legitimate severance of employment. So a prearrangement, as I just described, does not qualify as a legitimate severance of employment. Okay, so you have to stop performing services and have no intent of returning to work for any employer who contributes to the pension fund. The exception would be if you are already 65 and you are not working in prohibited employment. So you're 65 and you're driving that delivery truck now for Pepper Construction or for McHugh Construction or another signatory employer. You're driving a delivery truck. You're not working with the tools. You're not doing anything that's prohibited anymore. If you are already 65, you can start your pension without a severance of employment, provided that the work you are still doing is not prohibited. So it's okay to be 65 and drive a truck for a signatory employer, drive a delivery truck for a signatory employer, because the work that you are doing is not prohibited. That doesn't mean that you can be 65 and start your pension while you're still a foreman or you're still a superintendent or you're even still working with the tools. Those things are not okay because those jobs are still prohibited employment. Okay, so at 65, you don't need a severance provided that the work you're doing is not prohibited. Okay. So a couple questions still coming through the chat about what is and what isn't prohibited employment. So prohibited employment is on the slide and in the handouts, pages 45 to 47 in the pension handouts. Employment, self-employment, or any other business activity in the trade or craft of carpentry or other business activity covered by a collective bargaining agreement or a participation agreement. So pre-65, you cannot work in any occupation that's considered prohibited employment in any geographic location. Between 65 and 70 and a half, you can work in an occupation that would be considered prohibited employment, provided you are working less than 40 hours a month. So this is called the 39-hour rule. Okay, it's been around as long as I've been with the plan. Once you reach age 65, and you have to be 65, you can't start your pension at 55 or at 60 and do this, but once you reach 65, you can work with the tools or as a foreman or a superintendent or a project manager or anything else that might be prohibited employment. You can do that provided that you work less than 40 hours per month. So it's okay to work 39 hours a month. Those hours are not transferable from one month to the next. So if you are 65 and you do not take advantage of the 39-hour rule, say for 2 months, then in month 3, you cannot go work triple. So you can't say, oh, I didn't work my 39 last month, I'm going to work double this month. It doesn't work that way. It's a use it or lose it type of thing. You are allowed 39 hours a month in prohibited employment if indeed you are 65 or between 65 and 70 and a half. Once you reach 70 and a half and older, in accordance with federal regulations, you can indeed draw your pension and still be working full-time at any type of employment, including prohibited employment. So once you're 70 and a half, you can draw your pension and still do any type of work that you like. So coming through the chat are pardon me, quite a few questions about what is and what isn't prohibited employment. So here are some examples. And again, these examples are in your handout, in the pension handout in page 46 to 49. So what is prohibited? You certainly cannot work with the tools. You can't be a building inspector for a contractor. You cannot be a project manager, a supervisor, a superintendent, a foreman. You can't do any of that for a contractor. You cannot continue to be an employee of the council, an employee of the fund office, an employee of the apprentice school. You can't do any of that. You cannot be a member of the e-board or a delegate or a business agent or a trustee or an officer of any local. The little sort of, I guess you could say, exception to that is if you're an officer of the local, you could finish your term, but you cannot run for another term. So that's there. So what is not prohibited employment? So these are just some examples. There are many, many, many things that are not prohibited employment. It's not prohibited employment for you to go drive a bus. It's not prohibited employment for you to go sell shoes. It's not prohibited employment for you to open an ice cream parlor. Okay, so there are many things that are not prohibited employment, but this is just a little list of things that we are asked about frequently. So it's not prohibited to be a building inspector for a state, county, or a municipality. You can be an inspector for home purchase or sale, for compliance review. You can do sales. So at one of those big box hardware stores that sell cabinets or something like that, or flooring, you can work in the store and you can do sales, provided that you are not the one going out to do the installation. So you can't be the person going out to install the flooring or to install the new cabinets that somebody bought at one of those big box hardware stores. It is not prohibited employment to do picket duty. So you can work for the regional council doing picket duty while drawing your pension. You can certainly volunteer. It's okay for you to volunteer at a local community organization or your church or your synagogue or something, and do construction work for which you are not getting paid. Volunteer work means you're not getting paid. So you can go help Habitat for Humanity build houses for those in need, because it's volunteer work that you're not getting paid for. It's okay to be a draftsman, a CAD designer. It's okay to be a safety director. You can be a corporate officer. If you are an owner of a business, it is okay for you to be a passive owner and draw your pension. So you don't have to sell the business, but you can no longer be involved in the running of the business. So passive ownership is something like you have a company, a construction company up here in Chicago, and you're going to go retire out to Arizona or Florida, and your kids are going to run the business up here in Chicago, or you're going to hire someone to run the business up here in Chicago, but you are disengaging from the business. You are retiring, and no longer involved. So that's the listing we go over here, and these examples apply to both union and to non-union work. So a lot of questions coming through the chat, and I'm going to warn you ahead of time that a lot of these you're going to have to call the pension fund office and talk about. So what type of employment can you do and still earn credits after retirement? Well, we already talked about that. Once you're 65, if you choose to, you can go back to work for a signatory employer, and you can work the 39 hours a month. Once you're 70 and a half, you can go back to work for a signatory employer, and you would still earn credit in those capacity. After I retire from the company I work for, will I be entitled to a year of severance pay after I work? That's between you and the company. We're not going to say that the company can't compensate you for whatever severance pay you have with the company. They should not be making contributions on your behalf. In fact, they can't be making contributions on your behalf. And you certainly cannot be working. I mean, the definition of severance pay would be you're not working anymore. Yes, you can do consulting regarding the viability of a certain project for a contractor. Can you do maintenance work? Maintenance work is always a touchy classification, and we always, always, always ask for a written job description of what you mean by maintenance work. If you mean by maintenance work that you're sweeping the floor, you're emptying the trash can, and you're cutting the grass and shoveling the snow, absolutely, that's not a problem at all. You can do maintenance work, again, as long as it's not for a signatory employer, because you need that severance of employment. But if your definition of maintenance work is, I'm going to fix the window sash that needs repairing, and I'm going to rekey locks on a door, and maybe I'll sweep the floors too, but I'm also going to repair the wall that somebody broke for some reason. Those types of maintenance work are not permitted. So if you're going to call the fund office and ask about maintenance work, I guarantee you any of my team here at the fund office is going to say, I can't answer that maintenance question over the phone. Please submit a written job description from your prospective employer on company letterhead, and then we'll send you a written determination back to you. And by the way, that's actually leading us into our next slide. If you want to return to work after your pension starts, or if you are uncertain about whether or not the work you are currently doing or thinking about doing would be considered prohibited employment, you can do this prior to retirement also. What you want to do is send in a written description of the job prepared by the employer on the employer's letterhead to the fund office. We will review that description and we will get back to you in writing for your records as to whether or not that job you're describing is considered prohibited employment, whether or not you can draw your pension while still doing that particular job. This written determination system, it protects you and it protects the plan. So you just, for example, say you do this verbally over the phone. You call over the phone, pardon me, you say you're thinking of doing maintenance work, and Joe tells you that it's okay to do maintenance work. And then 6 months later, for whatever reason, we find out that you're doing maintenance work, and we notify you that this maintenance work involves rekeying locks and fixing the window sashes, and it's prohibited employment, and we're going to suspend your pension. And oh, by the way, you owe us back 6 months of pension payments for all of the time that you did this prohibited work. So when that happens, you're going to say, but wait a minute, I called Joe and Joe said this was okay. Well, you got two problems there. Number one, it's verbal. You have no proof of this. And number two, there's no Joe who works at the pension fund office. So, the written system is the best way to do it. Now, you certainly don't need to send in a written job description if indeed you are going to be driving a bus or opening an ice cream parlor, to use my earlier examples. But if you're doing anything that you're concerned might be considered prohibited, or you think we might consider it prohibited, then you definitely want to do this in writing so that you have it for your records. And, if we do come back at you later and say, hey, it's prohibited, you can pull out the letter from the pension fund that you sent in for a predetermination to say, hey, look, you already told me that this is not prohibited and I'm perfectly fine. Keeping an eye on the chat over here. The last question I see coming through the chat right now is, if you start your pension early at 60 or 62, and then when you eventually reach 70 and a half, is it okay to go back to work in prohibited employment at 70 and a half? Absolutely. You can definitely do that. You can go back to any type of employment you want, prohibited or not, once you reach age 70 and a half. Also, if you are interested in doing the 39-hour rule once you're 65, there is a one-time form that you need to fill out for the fund office to indicate that you are going to do that 39-hour rule. That's in the pension handouts on page P49, that form, if you're interested in taking a look at that. Okay. In general, can you stop your pension and go back to work? Yes, indeed, you can. Notify the pension fund office ahead of time. We will suspend your monthly pension benefit for however long you're going to be working in prohibited employment, and then you can complete something called a reinstatement application in order to reactivate your pension. So you can stop as long as you tell us ahead of time. Okay, that's all I see coming through the chat, and that's all I have on my slides about this particular subject. Please remember that it is perfectly fine to give the fund office a call with additional questions. I briefly want to talk about the supplemental retirement plan, and then we're going to take a short 5-minute break and come back and talk about retiree health benefits. So the supplemental retirement plan, some people call that the SRP or they call that the annuity plan. Some people still call it my Putnam because Putnam was the record keeper when we first started, and then it changed to Mercer. So talking about supplemental retirement plan, annuity plan, Putnam, Hancock, Mercer, we're all talking about the same thing. We're just using different words to describe it. So John Hancock Retirement Plan Services is currently the plan record keeper. You can each register, if you haven't already done so, on the John Hancock website to view your supplemental retirement plan balance. The current contribution rate for the construction plan is $9 an hour, and the current contribution rate for most mill employers is $1.25 an hour to the supplemental retirement plan. So you have an account balance at John Hancock. You are welcome to withdraw that balance at the time of retirement and in certain circumstances even before retirement. So if you have questions about those, you can give the fund office a call. But the application to withdraw your supplemental retirement plan balance comes directly from John Hancock. So you can either go online at myplan.johnhancock.com, or you can give John Hancock a call at the phone number on your screen in order to obtain an application for benefits. Remember, I mentioned earlier, you can take your partial lump sum, you can roll that into John Hancock if you choose to do so. Certainly no obligation for you to do so, but think about the fees relative to some fees that some other financial institutions may be charging you. At the time of retirement, you can keep your money in the supplemental retirement plan, or you can withdraw that supplemental retirement plan balance. If you withdraw your supplemental retirement plan balance, you basically have the same options that we talked about with respect to the partial lump sum option. If you withdraw in a lump sum, the benefit can be paid directly to you, whereby it becomes taxable income for the year when you file your taxes. And John Hancock is required to hold back 20% to credit against your federal income taxes. Or you can take that supplemental retirement plan balance and withdraw it and roll it over to an IRA or other qualified retirement plan of your choosing. John Hancock will cut a check to that other retirement plan, and you can do a rollover on it that way. You also have the option of electing to start installment payments from John Hancock. And you can do installment payments on a monthly, quarterly, or annual basis. So you can start drawing down on your supplemental retirement plan account in installments. You don't have to take the whole thing as a lump sum up front. So John Hancock, you can go online on the computer to their website, or they have vastly improved. Last year, they vastly improved actually their app for your phone. The old app was, even John Hancock admits, the old app for your phone, even John Hancock admits, was pretty bad. I mean, all you could do was really see your balance. You couldn't do much of anything else. But with the new application, you can see balance, you can see rate of return, you can request forms. So all of those types of things are available through the John Hancock. Question came through on the chat. Do I have to take my John Hancock account out now? And the answer is no, you do not have to take your John Hancock balance out of the supplemental plan at the time of retirement. Just like the pension plan, though, the government does require that you start getting required minimum distributions. So if you still have a balance in the John Hancock supplemental plan, you will start having to take installment distributions or required minimum distributions starting the April after the year in which you reach 72. Okay, so someone's putting through in the chat that they can't hear me. Nothing has changed on my end. Can somebody else put through the chat if you can hear me? Yes or no? Hi, I can hear you. Okay, thank you. Those of you, I just wanted to make sure nothing happened to my phone here. It looks like I'm still all connected. I appreciate that assistance. Um, and with that, we are actually at our last break. Again, the QR code on the screen here will take you right to the portal if you did not download your estimates from the portal. It's 11:56 on my side, so let's come back in 5 minutes at 12:01, and I will start talking about retiree health benefits. And I am hopeful that will be done by about 1 o'clock or a few minutes thereafter. So I will start talking again at 12:01. The chat is still available for your questions. Thank you. Okay, I am back, and I hope you are back to join me. Again, if you can't stay for the end of the presentation, please remember this is being recorded and will be posted on the Fund Office website. So our final topic of the day is retiree health benefits. So this slide is just an overview. We'll talk about eligibility requirements. As I'm talking here, if you printed out your pension credit from the portal, you might want to look back and take another look at how many years of vesting service are listed on that pension credit printout. We'll talk about active plan eligibility at retirement and how that impacts. We'll talk about premiums for coverage. We'll talk about postponing enrollment, what you can and can't do as far as postponing retiree plan enrollment. We'll talk about the different types of coverage available for those who are not yet on Medicare and for those who are on Medicare or when you become Medicare eligible. We'll talk about some additional benefits available under the Retiree Health Plan of Benefits. We'll touch on the Carpenters Center for Health and Vision out in Lisle, and we will talk about prescription drug benefits. Okay. So your retiree health benefit election forms, enrollment forms, are completed at the same time you fill out your pension application. In order to be eligible for the retiree health benefits, in general, you must have at least 10 years of eligibility service, and for most people, eligibility service will be the same as the years of vesting service that are listed on your personal credit printouts from the portal. However, if at any time during your career as a carpenter, you went 3 consecutive calendar years without earning credit, then the requirement for retiree health benefits increases to 15 years of eligibility service. Okay. And again, provided that your employer was paying into both the pension fund and the health and welfare fund, which most employers do, the number of years of vesting credit on your credit printout from the portal is probably equivalent to the number of years of vesting service that you have on your record. Okay. So most people who were registered today, not all, but most people who were registered today are still eligible for the current active working carpenter medical benefits, the active working carpenter health benefits. Okay. But some of you aren't. So if you are not eligible for the active working carpenter health benefits at the time of retirement, at the time your pension starts, and if you are eligible for retiree health benefits, then your retiree health benefits are going to start on your pension award date, the month that we cut your first pension check. Now, if you remember a little while ago, we talked about the effective date and the award date on benefits. Sometimes the award date is after the effective date, and you get a couple of months of back pay on your first check. Health benefits, for those of you not eligible for the active plan of benefits right now, retiree health benefits start on your award date when we cut your first pension check. Retiree health benefits do not go retroactive to your effective date. So that's another reason to apply early. Make sure you get your application in that 4-month time frame that we talked about, as opposed to waiting to the last minute, especially if you need the retiree health benefits. If indeed you are eligible for active carpenter health benefits at the time your pension starts, you stay eligible for those active carpenter health benefits. So your active health benefits do not shut off just because you start collecting your pension. Okay? You're going to run out your active eligibility before you move on to the retiree eligibility. So even if you're starting your pension benefits for, let's say, January 1st, for example, if your active benefits are good until the end of May, that's fine. You're a pensioner as of January 1st, but you stay covered by the active working carpenter health plan of benefits through May. And then in June, when your hours run out, then a change happens. And what is that change? Well, that change that happens after the active benefits end really depends on what you elect. So you are still going to be eligible for the active working carpenter health benefits until you fall below 1,000 hours in the past 4 calendar quarters. And when your hours basically run out, when your 1,000 hours in the past 4 quarters, you don't meet that requirement anymore, then you have 2 options. Your first option is you move directly from the active benefits onto the retiree plan of benefits. And in that case, the retiree benefits would automatically begin the first of the month after your active benefits end. And this is really what happens for most people. You move from the active benefits onto the retiree benefits. We'll talk about retiree premiums on the next slide, okay? But that's what happens for most people. However, some people occasionally decide that after the active plan of benefits end, they're going to take advantage of the COBRA option. So I think COBRA, sometimes people, it's a little bit mysterious. They're wondering, what is this COBRA option? COBRA is not necessarily the name of any type of different coverage. COBRA is an acronym for a law, and it stands for the Consolidated Omnibus Budget Reconciliation Act, and I believe it's of 1985 or 1986. And what that COBRA law basically says is that when your active working carpenter benefits end, when your hours run out, and your active carpenter benefits end, you have the option, and this isn't just for somebody who's starting pension. This is for the 30 or 35 or 40-year-old carpenter out there in the field who's still working. If you run out of hours, you don't have enough hours to be eligible for the active benefits, the COBRA law says that you have the right to buy the active benefits for an 18-month period. So while you're eligible for the active benefits, you don't pay a monthly premium. There is no deduction coming out of your paycheck to sponsor your active working carpenter health benefits. You have those benefits by virtue of the hours that you're working for a contributing employer. But when you run out of hours, you fall below 1,000 hours in the past 4 quarters. If you want to keep the active plan of benefits going, you can pick up what is commonly called COBRA continuation coverage. And you can do that for a maximum of 18 months. And then after that 18-month period is over with, you can then move on to the retiree benefits. And in that case, your retiree benefits would start the first of the month after your continuation coverage under COBRA ends. Okay. You are under no obligation to take the COBRA coverage. You can certainly do what the blue graphic at the top of the slide shows. You can move from the active benefits directly onto the retiree benefits. And I imagine that what your decision is going to be dependent upon what the premiums are. So let's start with the COBRA premium, because that's the easiest to describe, to tell you about. In the handouts for today, if you printed the handouts for today or if you downloaded the handouts for today, in the health plan handouts on page H4, the COBRA premiums are listed. So the current COBRA premium is $681 per person per month to keep the same benefits you have under the active plan of benefits, including the vision and the dental benefits. Okay. You can also pick up COBRA continuation coverage of the active benefits at a lesser premium of $616 a month, and that is without vision and dental benefits. Okay, so if you choose to, you can go on the COBRA for either $681 or $616 per person per month for up to 18 months, and then come on the retiree plan of benefits. Without the COBRA, to move directly from the active to the retiree benefits, that's okay too. And let's now talk about what the retiree benefits are going to run you. Okay. So on the handouts, I've just duplicated the chart on page H1 of the handouts on the slide in front of you. Okay. How much you pay for the retiree plan of benefits depends on how many years of eligibility service and or vesting credit that you have. So look on your individual pension credits that you printed from the portal, see how many years of vesting service you have, and then just follow along in the chart. So if you have 30 or more years of vesting service and you are not Medicare eligible or your spouse is not Medicare eligible, you're going to pay $187 per person per month for the comprehensive medical coverage. That's the Blue Cross Blue Shield. Okay. If indeed you or your spouse is Medicare eligible and you have 30 or more years of vesting service, you're going to pay $47 per person per month for the comprehensive Medicare supplement. If you are married and one of you is Medicare eligible and one of you is not Medicare eligible, so maybe your spouse is Medicare eligible, but you, the carpenter, are not Medicare eligible, and if you have 30 or more years of service, eligibility service, then it's $187 a month for the person who's not Medicare, Blue Cross Blue Shield, and then an additional $47 a month for the person who is Medicare, Blue Cross Blue Shield, Medicare supplement. So you need to do a little bit of math here to arrive at your premium. Okay, so these first two columns, the 187 and the 47 if you have 30 years, are up at the top here where it says non-Medicare eligible comprehensive medical coverage or Medicare eligible Medicare supplement. Those are for Blue Cross Blue Shield. So these first two premium columns are the premiums for the Blue Cross and Blue Shield based on whether or not someone is Medicare eligible. The third column over here is the premium for the prescription drug coverage. So you pay a separate per person per month premium for the prescription drug coverage. And if indeed you have 30 or more years of eligibility service, vesting service, then the prescription drug premium is $75 per person per month. So again, a little bit of math. If both you and your spouse are not Medicare eligible and you want the Blue Cross Blue Shield and the prescription coverage, then it's 187 times 2 plus 75 times 2. Again, assuming you have 30 years of eligibility service, 30 years of vesting service. If you have less than 30 years of vesting service, find the appropriate row and look across here. So maybe you only have 10 years of vesting service, in which case pre-Medicare Blue Cross Blue Shield is $300 per person per month, and Medicare Supplement Blue Cross Blue Shield is $80 per person per month, and prescription drug coverage is $106 per person per month. Okay. So you need to do the math to back into the premiums. We'll look at vision and dental in a moment. Okay. The premiums will be deducted from your monthly pension payment. As I've already mentioned, Blue Cross Blue Shield and prescription drug coverage are separate options with separate premiums. Vision and dental coverage are separate options with separate premiums, and we will look at those premiums on the very next slide. These current premiums that are listed right here are current and are subject to change. The retiree has to have coverage before the spouse or dependent can take coverage. So, for example, if you, the carpenter, decide that you only want to take the Blue Cross Blue Shield coverage and you do not want to pick up the prescription coverage, then your spouse or your dependent children can only pick up the Blue Cross Blue Shield coverage. They cannot pick up prescription coverage unless you, the carpenter, also enroll in prescription coverage. Okay. So that's there. Also, your dependent children up to age 26 are eligible to elect coverage. If you happen to have a disabled dependent, coverage can be continued past age 26, provided certain requirements are met. So you want to give the fund office a call to talk about disabled dependent enrollment requirements. Medicare eligibility is on an individual basis, so the retiree and the spouse, or the retiree, spouse, and dependent children can have different types of Blue Cross Blue Shield coverage, meaning the pre-Medicare coverage or the post-Medicare coverage, depending on your Medicare eligibility status. Okay, let's look at the vision and dental coverage premiums, and then I'm going to come back to this slide for a moment. So your vision and dental enrollment under the retiree plan are also separate premiums. Dental, if one person is enrolled, it's $44.53 a month. 2 people enrolled is $86.42, and 3 or more is $153.33. Vision is $620 for one person, $11.96 for 2 people, and $18.22 for 3 or more people. Okay. So I'm actually going to go back to the other slide with the rates here, because I want to talk about the premiums for a moment before we start talking about different types of coverage. I sometimes think that when you see these premiums, it's a little bit of sticker shock, especially those of you who have had active working carpenter health benefits for many years. You know, maybe you've consistently worked for one employer, you've had coverage for many, many years. In no way, shape, or form are you obligated to enroll in these retiree coverages, okay? And I strongly encourage you to investigate outside carriers and see what it would cost you to pick up coverage on an independent basis from Blue Cross or from Aetna or from MetLife or from Humana, you know, whatever other plan is out there. I strongly encourage you to compare these premiums that are here on the slides and the handouts today to the premiums available from other companies. In no way, shape, or form is the retirement benefits fund, the health fund, making any kind of a profit or anything on the retiree health benefit premiums. In fact, the retiree premiums are less than the actual cost of coverage to the plan. Okay, the active working carpenter hours highly subsidize these retiree premiums. In fact, for someone who has 30 years of eligibility service, 30 years of vesting credit, the premiums listed here on this sheet are only about 25% of the true cost of coverage. The active working hours are subsidizing about 75% of the retiree premium. Even somebody with only 10 years of eligibility service or vesting service, you're only paying about 60% of the actual cost of coverage. At a 10-year level, there's about a 40% subsidy on the retiree premium rates by the active working hours. Overall, only about 33% of the cost of retiree coverage is actually covered by the retiree premiums. The other 66 or so percent is subsidized by the active working hours, by those employer contributions to the health fund. I also mentioned several times that These are current premiums, and these premiums are subject to change. That is a very true statement. However, I can tell you that the trustees of the plan understand that how much you have to pay for coverage is certainly a contributing factor into your retirement decisions. The premiums that are listed here are the premiums that have been in place on the Blue Cross Blue Shield and prescription coverage. Those premiums have been in place since 2011. There has not been an increase in premiums since 2011. The trustees do everything they can to keep these premiums at a manageable level. Can I guarantee you that they won't go up in the future, or can I tell you that they are absolutely going to go up in the future? No, I can't. I mean, my guess is that at some point in the future, there's going to be no choice but to increase the premiums. But it is certainly not a decision that your trustees would take lightly or, do willy-nilly. There's a lot of financial studies that go into the different premium letters and how much you pay for those premiums. Now, the vision and the dental premiums, the trustees do not set these premiums. So the vision and the dental premiums in the last couple of years have increased slightly. Dental is through Delta Dental, and vision is through VSP Vision. And those two providers actually set the premiums for vision and dental. So there have been some slight, couple of dollars, literally a couple of dollars a month premium increases on the vision and the dental the last couple of years. As far as the vision and the dental, there are open enrollment periods. So on vision and dental, if you do not pick up vision and dental at the time you start your pension benefits, you can enroll in vision and dental later on. You could enroll in vision and dental during the annual open enrollment, which generally runs from January through March 15th with coverage starting April 1st. Again, the retiree, the carpenter, has to be enrolled in order for the spouse or the dependents to enroll in any of these types of coverage. And if you enroll in vision and or dental and you use coverage and then you cancel coverage before you're enrolled for at least a whole year, you will not be allowed to re-enroll during the annual open enrollment period for at least 2 years. Okay. So each of the elections is a separate election. And on the screen here is a sample enrollment form. And this enrollment form is in the health benefits packet. A sample enrollment form is in the health benefits packet on page H7. Okay. So this screen in front of you is the participant, the Carpenters enrollment elections. There are separate enrollment elections just like this for the spouse and for each dependent child. So you tell us whether or not you're Medicare eligible. And if you are Medicare eligible, you have to send us a copy of your Medicare card. So this first section, Part B here, where the circles are, this is your Blue Cross Blue Shield. And you tell us, yes, you want to enroll in the comprehensive medical benefit Blue Cross Blue Shield, or no, you don't want to enroll in the comprehensive medical benefits. And then the third option is you currently have some other coverage, so you don't want to enroll now, but you might want to enroll later. So this Part B is strictly about Blue Cross Blue Shield. Do you want the Blue Cross Blue Shield? Part C is a separate election about prescription drug coverage. So the squares, yes, you want prescription drug coverage. No, you don't want prescription coverage, or you have coverage and maybe you want to enroll later. The diamond shape here in Part D, this is all about the dental coverage. Yes, you want the dental. No, you don't want the dental, or you have other dental coverage. And then the triangles are about the vision coverage. Yes, you want vision. No, you don't want vision. You have other vision coverage and maybe you'll want to enroll later. So each is a separate option. The carpenter can say, no, I don't want Blue Cross Blue Shield in Part B at all, but I do want prescription coverage. No, I don't want dental, but I do want vision. So in that scenario I just gave you, the Carpenters only enrolled in prescription coverage and vision coverage. The spouse and dependent children can only enroll in whatever type of coverage the carpenter is enrolled in. So if the carpenter only enrolls in prescription coverage and vision coverage, then the spouse and dependent children can only enroll in prescription coverage and vision coverage. In order for the spouse and dependent children to enroll in any of these coverages, the carpenter must also enroll. So if the carpenter takes Blue Cross Blue Shield, the spouse and the kids can choose or maybe not choose Blue Cross Blue Shield. Just because the carpenter takes coverage doesn't mean that the spouse and the kids have to take coverage. Again, it's a separate section for each type of coverage, and it is a separate form or a separate section of the form for the spouse and a separate form for each dependent child. Okay. So that's how the enrollment works. I'm going to talk about postponing enrollment for a moment, and then I'll go over to the chat and see what questions are coming through. Out of the corner of my eye, I see everybody's, not everybody, but quite a few questions have come through. I just want to get through this part of the presentation before I actually read your questions. So what happens if you check that bottom box on the enrollment form that says you have other coverage and you don't want to enroll in the carpenter's coverage at this point in time? Well, you can enroll in the carpenter plan at a later date, provided that you maintain coverage with another plan during the period that you're not enrolled with carpenters. So, for example, maybe your spouse works outside the home and your spouse has insurance coverage with your spouse's employer. Maybe your spouse isn't retiring yet. So maybe for the period of time while your spouse is still working, you're going to be covered under the spouse's employer plan. So if you're covered under your spouse's employer plan, you don't necessarily need the carpenter's retiree health benefits, and you could come on to the carpenter's retiree benefits after your spouse's employer benefits end. Or maybe you do as I just suggested, and you do some research and you find a plan with Humana or MetLife or any other program that's out there, and you find a plan that you think is a little bit less expensive than the carpenter's plan, and you enroll in that plan and you maintain coverage with that plan for a year or 2 years, then you can come back to the retiree plan after that other plan ends or when that other plan is ending, and you can add the carpenter retiree plan at that time. But the retiree health benefits must begin immediately following the end of the coverage with the other plan. So your coverage from your spouse's employer or coverage that you buy directly through Humana, that coverage can't end in January and then 9 months later in September you decide you want to come on to the retiree plan through the carpenters. It has to be consecutive. You move from one plan on to the other plan. If you're going to do this and postpone coverage and you do want to come back to the retiree plan at a later point in time, you must request enrollment forms and return those enrollment forms. Pardon me, one moment, please. Sorry, talking too much. Needed a little sip of water. You must request and return enrollment forms to the retiree plan to our fund office here. You have to send in enrollment forms 30 days before coverage under the other health plan ends so that we can process your enrollment in the retiree plan of benefits. Okay. One more slide, and then I'm going to jump over to the chat and look at your questions because I still have other information to tell you about, and we're still going to look at the different types of coverage. Right now, we're just talking about premiums and enrollment. So drum roll, please. This was great big news back in 2019 when this first happened, because for years and years, this was not the case. One of the most frequent questions we get is what happens to my surviving spouse's coverage if indeed I, the carpenter, pass away first. So starting in 2019, surviving spouses can keep the retiree plan of health benefits for the surviving spouse's lifetime at the same premiums we just looked at, as long as they don't remarry. So this is a little bit different from the pension payment options. I emphasize that if you take a 50, a 75, or 100% pension payment option, that surviving spouse's monthly pension check, the pension money, continues for the surviving spouse's lifetime, whether or not the surviving spouse subsequently remarries. The surviving spouse keeps the pension check, keeps the pension money. So while surviving spouses are now afforded an opportunity to continue the retiree health benefits after the passing of the carpenter, if the surviving spouse subsequently remarries, the surviving spouse's health benefit coverage will end upon remarriage. Also, even if you do not pick the 50%, 75%, or 100% joint and survivor options on the pension payment, even if you took a single life annuity with a 60 certain month guarantee, your surviving spouse can still pick up the retiree health benefits. It's just if the surviving spouse is not getting a monthly pension check under that 50, 75, or 100% joint survivor, the surviving spouse is going to have to submit payments for the retiree health benefits to the pension fund office. Okay, let's take a look at some of the questions coming through your chat, and then I have a few other things to talk about with coverage, and then we'll wrap it up. So let's see what questions you've been sending through here. If I retire at 60 and join my wife's health plan in lieu of selecting the Carpenters plan, can you join back? Well, we just answered that, and the answer, sir, is yes, indeed, you can, provided you have continuous coverage with your wife's employer's plan. Clarify when the active benefits stop. Your active benefits stop after you fall below 1,000 hours in the past 4 calendar quarters. So it's a little complicated to describe, and I don't have a slide to go over this, but the Active Carpenter Summary Plan Description booklet, which is available on our website at carpenterbenefits.org, go under Resources, pick the health plan, and look for the documents. The Active Carpenter SPD can explain it better, or you can give the fund office a call next week and they can go over that in more detail. We can go over that in more detail with you on a one-on-one basis. But when you fall below 1,000 hours, sort of in your bank, I guess, we don't really have a bank, but I guess that's a term that people follow, that's when your active benefits are going to end. And then you can either move to the retiree plan of benefits, or you can pick up continuation benefits under continuation coverage under COBRA. Let's see. Question about the HRA card, the Carpenter's HRA card. You can continue to use that HRA card through, it was Connect Your Care, and now I believe it's Optum Financial. So you get $1.50 an hour for each hour that you work paid onto your HRA card. You can use that to continue to cover co-payments, co-insurance, deductibles, things like that under the retiree plan of benefits, provided that you stay an active member at your local. You continue to pay your local dues. You don't go into arrears on your dues. So that HRA card, you can even use it to pay your retiree premiums. Now, you have to use it sort of on the back end. We have to deduct your retiree premiums from your pension check. But if you give the fund office a call or even go online, you can print your retiree premiums off and you basically use it as a receipt to apply to Optum for you to get reimbursed for your retiree medical premiums coming out of your pension check. Let's see what we've got here. Question. A couple of questions going back to prohibited employment and taxes. Please give the fund office a call. We've already moved past those sections. Or if you'd like to stay on after the presentation, I can certainly type some answers for you on those. Okay. So regarding the packet of information, the handout on the retiree health benefits today, starting on page H13, so page 13 of the retiree health benefits handout packet, there's a booklet called Getting Ready to Retire. I have a picture of the cover of that booklet here. It's about a 10-page booklet that's really easy to follow and understand the retiree benefits. So it's much easier to understand than the 150-page summary plan description about the retiree benefits. That said, the 150-page or 120-page retiree health plan summary plan description is posted on our website at carpenterbenefits.org, and you are certainly more than welcome to read that. But for those of you just looking for, a quick reference or a summary of the retiree benefits and provisions, that the Getting Ready to Retire booklet on page H13 in the retiree handouts is a good place to look. Also, for dental coverage information in the handouts, dental coverage chart is on page H28 in the health benefits handout, and the vision coverage chart is on page H31 of the health benefit handouts. Okay. So a couple of things. Well, actually, we still have quite a bit to talk about. But as far as the retiree health benefits, when you move from the active plan to the retiree plan of benefits, it's important to understand that any active plan deductibles or out-of-pocket maxes that you might have already met under the active plan do not carry over to the retiree plan. You have to meet a new deductible, new out-of-pocket max under the retiree plan. So, for example, if you are retiring January 1st and you have enough hours that you still have your active health plan of benefits, let's say through the end of May, your active plan of benefits is going to end June 1st. Well, you go to the doctor and maybe you have a couple of procedures done and you have maybe some x-rays done, something like that, all from January through May. And you've met your deductible and maybe you've even had some extensive procedures done and you've met your out-of-pocket max for the year. And then on June 1st, you move to the retiree plan of benefits. On June 1st, when you move to the retiree plan, it's a new plan. It's a separate plan. So you have to meet a deductible under the retiree plan of benefits also. So the active plan deductibles don't carry over. The out-of-pocket max deductibles do not carry over to the retiree plan. Under your active plan, you have a network of benefits called Absolute Solutions. So if you need radiology, you need x-rays, or you need an MRI, or you need a CT scan, if you go through an Absolute Solutions provider, it's covered at 100%. The retiree plan of benefits does not include Absolute Solutions. Now, radiology and imaging services are most definitely covered under the retiree plan, but they're covered through your retiree Blue Cross Blue Shield, and they're subject to your deductible and then the 80% coverage. So it's not a 100% coverage under the retiree plan for radiology and imaging as it would be under the active plan if you're using an absolute solutions provider. The other thing I like to point out, for those of you who have been eligible for the active plan of benefits for many years, you're used to calling the fund office here down on Erie Street to ask questions about your coverage and about your claims payment. Well, once you move on to the retiree plan of benefits, Blue Cross Blue Shield will be your new contact for claims and coverage information. So while you can call the fund office retirement benefits department with questions about your premiums or questions about adding a spouse or dropping coverage, something like that, if you have questions about your coverage or questions about payment of claims, those questions will actually go to Blue Cross Blue Shield once you're under the retiree plan of benefits. You will get new Blue Cross Blue Shield cards when you move to the retiree plan of benefits. And the phone number for the retiree contact center at Blue Cross Blue Shield will be on those new ID cards. So something else to keep in mind when you move from the active plan to the retiree plan, you want to watch for new Blue Cross Blue Shield cards to come and make sure that your providers, your doctors, know that you have a new Blue Cross Blue Shield group number. It's happened many times that a retiree calls and says, well, I got this explanation of benefits in the mail and it says that I'm not covered, and I know that you take money out of my pension check every month. And well, that's very true. Usually what has happened is that retiree has not notified the doctor's office that he has a new Blue Cross Blue Shield group number, and the doctor's office still bills under the active group number. And since the retiree is not covered by the active group number anymore, the claim processed and said you're not covered. So those situations are usually resolved when the doctor's office, when the provider resubmits claims under the retiree group number. Okay. Question coming through the chat. Do you need to re-enroll in health benefits yearly? No, you do not. The elections that you make when you fill out your retiree health benefit enrollment forms along with your pension application, those elections will stay in place. The only time you need to do an annual enrollment is if you do not have vision and or dental, and if you want to add vision or dental. There's the open enrollment period for vision and dental from January through the middle of March. But you do not need to do an enrollment every single year. Also, question coming through, what happens if I move to Florida with my coverage? Well, you're still covered in Florida. Blue Cross Blue Shield is a nationwide network of providers. Our PPO, and it's your retiree plan is a PPO plan, just like your active plan has been. It's just, you give your provider in Florida or Arizona or Montana or New York or wherever you move, you give the provider your Blue Cross Blue Shield card, and the claims will get billed back to Blue Cross Blue Shield of Illinois. If your provider by mistake sends your claim to Blue Cross of Montana, of course, Blue Cross of Montana is going to deny it because they don't, know who you are. But the group number basically lets Blue Cross Blue Shield's nationwide network know where your claims belong. So the Blue Network is what it's called, and they know to submit your claims to Blue Cross Blue Shield of Illinois, even if you're living in a different state or having services provided in a different state. Okay, so I'm going to look at the actual coverage now. We're probably going to go a few minutes past 1 o'clock because I want to go through coverage with you. So I apologize that we're going to go a little bit late. Again, if you have to drop, remember we are recording this and we'll have it posted for you. But so first, let's talk about retiree health benefits for those who are not yet Medicare eligible. So this coverage is very, very similar to the active plan of benefits that you're used to. It's a Blue Cross Blue Shield PPO plan. Your deductible is $300 per person per year. for PPO providers. If you have a family, if you have kids covered, your family deductible is $600 per year. So if it's the carpenter, a spouse, and 2 kids, not everybody has to meet that $300 deductible. As soon as 3 family members have met the $300 deductible, as soon as 2 family members have met the deductible, you've met your family deductible for the year. If you are using non-PPO providers, you have a separate additional $600 deductible per person per year. Your Blue Cross Blue Shield coverage is an 80-20 coverage. The plan's going to pay 80% and you're responsible for 20% at a PPO provider. If you're using a non-PPO provider, then the plan pays 60% of reasonable and customary expenses, and you're responsible for the other 40% of reasonable and customary allowance, plus anything that non-PPO provider is charging that might be over and above the reasonable and customary allowed amounts. You have an annual co-insurance maximum of $2,000 per person per year. So basically what that means is when you're out of pocket 20% on your copayment, if you go back up a line, you have a 20% copayment. Once your 20% adds up to $2,000 plus your $300 deductible, so we're basically talking $2,300 a year. That's basically the max of your liability during a year, because once you've met a $2,000 coinsurance maximum, the coverage from the plan goes up to 100% coverage for that individual for the balance of the calendar year. If you are using non-PPO providers, then you have a separate or additional $6,000 a year annual coinsurance maximum. Emergency room situation is the same as under the active plan of benefits. You have a $250 emergency room copayment. If you're admitted to the hospital within 72 hours of the emergency room visit or held in observation for at least 24 hours, then that $250 copayment is waived. Okay, so coverage very, very similar to the active plan of benefits. Question came through on the chat: how do pre-existing conditions of health get addressed? There are no pre-existing condition exclusions. So we do not look at all at pre-existing conditions. So once you're on the plan, any pre-existing conditions would be covered. We do not exclude for pre-existing conditions. Okay. So moving on, let's talk a minute about Medicare. So again, kind of like the COBRA words for the Consolidated Omnibus Budget Reconciliation Act, I feel like there's a little bit of confusion about Medicare. What is Medicare? What does Medicare cover? So there are 2 different parts to Medicare: Medicare Part A and Medicare Part B. Medicare Part A is the part of Medicare that's going to cover your facility fees. It's going to cover the hospital bill for an inpatient hospital stay. It's going to cover skilled nursing facilities, and it's going to cover some home and hospice care. So think of Medicare Part A as the facility fees. Generally, Medicare Part A is free as long as you have at least 40 quarters, which is about 10 years of work on record with Social Security with Medicare. In general, Medicare Part A is free. Not for everybody, but for most people. Pardon me. Medicare Part B is the part of Medicare that's going to pay the professional fees, what the doctor charges to see you in the doctor's office, what the surgeon charges to do the operation. Medicare Part B is going to cover your lab tests, your x-rays, the pathologist bill, the radiologist bill. So those are basically the things that are going to be covered under Medicare Part B. Medicare premiums, again, as I mentioned on the last slide, Medicare Part A, the hospital part of Medicare, the facility part of Medicare, is free for most people. You do not pay a premium for that. But Medicare Part B, the part that covers the professional fees, you do pay a premium for that. In general, it is deducted out of your Social Security check because Medicare generally becomes effective at age 65. So the Medicare Part B premium in 2023 for those new to Medicare, it's going to be $164.90 a month. Okay, $164.90. That premium actually went down slightly, or is going down slightly for 2023. For 2022, it was $170.10 a month for those new to Medicare. So that's Medicare Part A and B. And then your Carpenters plan is going to work as a secondary payer to the Medicare once you are Medicare eligible. Again, Medicare generally starts when you are 65. If you are disabled and you receive Social Security disability, 24 months, 2 years after you get Social Security disability, you will also get Medicare, even if you're not 65. Okay, so basically you only get Medicare prior to 65 if you are disabled and getting Social Security disability. Then you get Medicare 2 years after your Social Security disability starts. So either if you've got Medicare due to disability or you get Medicare because you're 65, Medicare must become your primary carrier. There is no provision under the Carpenters plan for the Carpenters plan to remain your primary carrier once you're 65 or once you're Medicare eligible. Okay, so Medicare becomes your primary carrier and the Carpenters Medicare supplement becomes your secondary payer to the Medicare. So under Medicare, if you are a patient in a hospital, a bed patient, an inpatient in a hospital, under Medicare, you have a deductible of $1,600. Your Carpenters Blue Cross Blue Shield Medicare supplement is going to pay that $1,600 deductible for the first 60 days of care. If you are in the hospital past 60 days, Medicare requires a copayment of $400 a day from the 61st through the 90th day when you're in the hospital. Your plan, your Carpenters Blue Cross Blue Shield Medicare supplement, is going to pay that Medicare copayment. On the doctor part and the surgeon part, the professional fees, the Part B. On Medicare Part B in 2023, there's a $226 deductible before Medicare pays everything. After you meet that $226 deductible, and oh, by the way, your Carpenters Blue Cross Blue Shield Medicare supplement is going to pay that $226 deductible for you. Then Medicare is going to pay 80%. And the plan is going to pay the other 20% of most Medicare approved expenses. So once you become Medicare eligible and you move on to the Carpenters Blue Cross Blue Shield Medicare supplement, you have very, very good coverage between Medicare and your Carpenters plan. And as those words came out of my mouth, I realized that sounds like I'm telling you you don't have good coverage before Medicare, and that is not true. Your Carpenters pre-Medicare Blue Cross Blue Shield Comprehensive Medicare Supplement is definitely an excellent plan. Again, you have your $300 deductible pre-Medicare on your Carpenters Blue Cross Blue Shield, and then the plan pays 80% with you paying the other 20% until you've met a $2,000 out of pocket. I think what I'm just trying to convey is once you hit Medicare, there isn't even the $2,000 out of pocket or the $300 deductible to worry about. Your Carpenters Blue Cross Blue Shield Medicare supplement is a very comprehensive supplement. And at really good prices too because of the subsidy that exists within the retiree premium. So again, feel free to compare the Carpenters Blue Cross Blue Shield supplement to other supplements out there on the market. Again, we do not make any kind of a profit under the retiree health benefit premium. So if you feel that another plan would work better for you, you're certainly welcome to drop the Carpenters Blue Cross Blue Shield coverage and move to an outside plan if you so desire. I don't see anything coming through the chat. Whoops, one just came through. Just one second. If you are still working at 65 and still eligible, you still have enough hours for the active working carpenter benefits, then yes, your active working carpenter benefits still stay your primary carrier, and you do not need to pick up the Medicare coverage until such time as you stop working or your active benefits end, whichever happens first. There's something called a Medicare. If you work past 65, there's something called an 8-month special enrollment period. So if indeed you work past 65, you do not have to pick up Medicare right away. But once you stop working or once you lose your active benefits, you have 8 months from whichever happens first. So 8 months from when you stop working, or 8 months from when your active benefits end. In most cases, it's going to be 8 months from when you stop working to get yourself enrolled in Medicare without a penalty. If that is not what you were asking, Scott, please call the fund office next week, and we would be happy to answer any questions you have on a one-on-one basis. That's how I'm interpreting your question, though. I don't see anything else coming through the chat, so I'm going to move on. Additional benefits covered under the Blue Cross Blue Shield for the Carpenters. You have coverage for chiropractic, acupuncture, and napropath care. The retiree, the carpenter, has 50 visits a year combined between those 3 types of service. A spouse would have 30 combined visits per year, and any dependent children who might be covered under the retiree plan, if they're at least 12 and older, have 15 combined visits. Retirees covered by the Blue Cross and Blue Shield plan also have hearing coverage. Hearing coverage, you can either use a hearing provider of your choice, or you can go through Epic Hearing. Coverage is 100% for a hearing exam once every 2 years, and coverage for hearing aids is $5,000 every 5 years for the carpenter and any carpenter spouse, and if you have any children covered who are older than age 18. That's a significant increase. Retiree hearing aid coverage prior to, I believe, 2019 was only $1,000 coverage. So that was definitely a benefit improvement in coverage. Lyra Health. The fund office has partnered with Lyra Health for mental health and wellness benefits and substance use disorder benefits. So as long as you are enrolled in the retiree Blue Cross and Blue Shield coverage, either pre or post Medicare, you have access, the retiree spouse and any covered dependents have access to 12 free sessions a year through Lyra Health. Retirees, not the spouse or any dependent children covered, but a retiree who is younger than 65 and enrolled in the Retiree Blue Cross Blue Shield program has a $25,000 life insurance benefit through the Hartford. Once you reach age 65, you can convert that policy to an individual self-pay policy with Hartford. It's not cheap. I don't have the premiums off the top of my head, but you could look into that. But there is no pre-existing condition exclusion, and there's no physical examination required or anything like that. Hartford will accept your conversion application. You have 30 days after you reach 65 to convert that $25,000 or part of the $25,000. So you might look at the premiums and think, oh, I don't want to pay the premium for the whole $25,000 in coverage, but I'd still like $10,000 or $7,000 in coverage, to cover my final funeral and burial expenses. So you could convert that to an individual pay, self-pay basis with Hartford. Retirees, spouses, and dependents covered by the Retiree Blue Cross Blue Shield are eligible to use the Carpenters Center for Health out in Lisle. And retirees, spouses, and dependents covered by the Retiree VSP Vision Program are also eligible to use the Carpenters Center for Vision out at the Lisle campus. Okay. My last topic is prescription drug coverage. So let me take a look and see what came through the chat. Question about the local union. Are there any benefits through the local above and beyond what is offered by Carpenters? In your handouts today, there's a booklet from the Midwest Coalition of Labor. And if indeed you remain a member in good standing with your local, continue to pay your dues, you're eligible for those benefits listed in that Midwest Coalition of Labor booklet that's in the handouts. As far as any additional benefits directly through your local, you would have to ask your local. We also usually get asked about, do you have to continue to pay your dues once you're retired? And again, I refer you back to your local. You should talk to your local to discuss dues. In fact, I think that's one of my last slides of the presentation here. Okay. Prescription drug benefits. Express Scripts is the carrier for prescription drugs for the retirees, just like for the actives, and the benefit plan under prescription coverage is the same as the benefit plan under the active plan of benefits. So you can get a maximum of 3 fills for long-term maintenance medication at a retail pharmacy. So if you take a blood pressure pill or a cholesterol pill or maybe some medicine for your diabetes, you can get those filled 3 times at retail at a CVS or a Target or anything like that. After 3 fills at retail, long-term maintenance medication must be filled either by the Express Scripts home delivery plan or you have to switch over to Walgreens. Express Scripts has a partnership with Walgreens. And this is new within, I'd say, the last 2 years, that you can get your 90-day supplies of maintenance medication directly through Walgreens instead of having it delivered to your home through Express Scripts home delivery. Now, regular medication for, say you have an infection and you need an antibiotic or something, those types of medicines can always be filled at retail. You don't have to get, a short-term medication filled by the Express Scripts home delivery or by a Walgreens. Those short-term one-off prescriptions are still covered at any retail pharmacy. Okay. Co-payments, same as under the active plan of benefits. Generic prescription filled at retail for a 30-day supply or 100 units, whichever is less, is a $5 copayment. Home delivery for a 90-day supply or picking up at Walgreens is a $12.50 copayment for a generic. For a single source brand drug where a generic doesn't exist, you have a 20% copayment at retail. Same thing, a 20% copayment through the mail order delivery or Walgreens. If there is a multi-source brand, and that means that a generic exists, but you, for whatever reason, or your doctor for whatever reason, do not want you to take the generic and you are taking the brand name instead, then you have a 35% copayment. Specialty drugs are covered by Accredo. Just how the slide is set up, this falls under home delivery or Walgreens. You actually have to get your specialty drugs through Accredo. And specialty drugs are things like, they're usually injectables. They usually require some type of special handling. many drugs for cancer or for rheumatoid arthritis or things like hepatitis. Many of those drugs are specialty drugs, and they're incredibly expensive drugs. You get a 30-day supply at one time. You have a 20% copayment with a $20 minimum and a $100 max. Occasionally the question will come through, $100 max. Oh my goodness, for a 30-day supply, that's so expensive. Let me put this in a little bit of perspective for you. The average cost of a generic prescription that is filled, and I'm talking cost to the plan, the average cost of a generic prescription filled is $22.14. And then you, the member, the carpenter, you pay your $5 copayment to that. The average cost of a brand name prescription, be it single or multi-source, the average cost of a brand name prescription to the plan is $543, and then you also have your copayments here. The average cost of a specialty medication is almost $4,000. Okay, so there's a big disparity in how much these different types of drugs actually cost to begin with. So when you're looking at the average cost of a $4,000 fill on a specialty medication, the $100 copayment maybe doesn't seem quite as much when you look at it in that context. Okay. We're almost at the end, so if you can hang with me for another 2 or 3 minutes, we'll be done. As I mentioned, we get a lot of questions about union dues. Do you have to continue to pay your union dues to have your benefits? So you need to talk with your local union about retiree dues and the benefits you get from those. Remember, as long as you stay a member in good standing, you can continue to use your HRA card, and you can take advantage of the Midwest Coalition of Labor members only benefits. And again, there's information on that in your handouts. Before we conclude, I'd like to remind you about the survey. When you exit the presentation today, after you exit the presentation, a survey will come up. If you don't have time or don't feel like doing that short survey right now, that survey will also come up on your email. An email tomorrow you will get, a follow-up email for the presentation. I think it's 6 questions. If you could just take a couple of minutes to fill that out, I would certainly appreciate it. Reminder, when your situation changes, we want to know. Let us know about address changes or changes to your marital status. Remember that you can update your address, your email address, and your phone number on the participant portal. Remember to keep those beneficiaries up to date. And remember that we are here for you. We are nice people. We are happy to talk to you. Please, please, please call the Retirement Benefits Department with any individual questions that you have about your record or anything that I didn't go into enough detail for you here today. Our phone number is up on the screen. Option 4 is the Retirement Benefits Department. And we also have a lot of information available on our website at carpenterbenefits.org. Thank you so much for attending. Happy retirement to everybody, and I hope you enjoy the rest of your weekend. Bye-bye now.